doesn't look like we've got a major issue with the economy at the moment. The economy's been relatively resilient.
Central banks have carved out in the last 6 to 9 months a focus on core inflation.
2024 should be a better year for earnings with the market.
We are seeing inflation coming back down towards where the Fed would like it to be.
In the end, higher for longer means there's going to be further tightening here in the real economy.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
The week begins right now, live from the City of London for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market is positive by 0.2% on the S&P 500. Hours away, TK, from Chairman Powell and that news conference.
And it's a different news conference than it was a couple days ago. Between the United Kingdom inflation coming in a little bit, I love what Paul Krugman said. We'll talk about Krugman's essay on disinflation here in a moment, but it's a changed outlook to the press conference than it was even 48 hours ago.
I'm told that it's a coin flip going into the Bank of England tomorrow. I will say this, 7, it's not 7, it's 6. Bramo, does that make a difference to you? The good news is it's not 7. The bad news, it's still 6% inflation in the UK.
The idea here is UK inflation did come in softer than expected. This is a positive, but how much of a positive? And you raise a good point. To me, the key distinction here is that the core measure actually came in much more than expected. So stripping out food and energy. How much are we going to be talking about the difference between core and all in, what you feel when you go to the store?
Well, that's going to be a theme today. I mean, we're there where we're slicing and dicing like David Rosenberg, what you do with inflation, disinflation, maybe parts of the world deflation. But the central bank story to me is they're completely data dependent, and that's what you're going to hear from the chairman today.
And this market is running with higher for longer, that's for sure. Cycle highs on a 10-year yield in the last 24 hours, Lisa. New cycle highs going into this Fed decision. Crude at around 95 on Brent. We pulled back a little bit on WTI, but we're right there on crude. So the headline versus core conversation, how do they navigate that a little bit later in the news conference?
I'm not sure, because if you take a look at goods inflation, it's starting to reignite. And so at a certain point, oil feeds into that. The question to me is, how much is it being driven by demand? Can you be bullish on oil without being bullish on the economy, right? I mean, basically, aren't you seeing the kind of growth, which is the reason why people say, look, yes, yields are going higher. Yes, oil is going higher, but it is doing so because there is that demand, because there is that strength.
The heart of the matter, and to start strong today with Ben Laidler, I think says so much about how the gloom crew has gotten it wrong, is there's a resiliency to corporations, to market participants of working in a new interest rate environment. First thing I looked at this morning, John, the 10-year real interest rate, it's at that 1.9x level. To go through 2% is going to be a change agent if we see that this afternoon.
Are you throwing shade at Bramo? And
No, I'm not throwing shade at Bramo. I just, you talk about disinflation, John. You don't see it on radio here, but behind John, John, I'm looking over at St. Paul's behind you, and there was inflation in the crumbs that they were serving tuppence a bag.
Right? Is that what you saw this morning?
I pulled out the farthing, and the farthing didn't go as far as they used to go.
Before we get deep in that nonsense, let's talk about a headline that came out in the last 24 hours. Amazon, holiday hiring. Bramo, 250,000 logistic workers. Pre-pandemic, that number was 200K. What was the number last year?
150,000.
It's getting better, right?
To me, this is actually really important. And there are people who say, well, actually, this is because more of the shopping is going online. Ironically, maybe people don't want to drive because gas is getting expensive. But either way, you're looking at a robust projection for a holiday season at a time where people are worried about that savings cushion supposedly going away. Where is that? It still seems to be there if Amazon is hiring that many more workers and offering $1,000 to $3,000 bonuses.
So do the UAW workers double dip? Do they go over there and move boxes around while they wait for
I'm not sure
Detroit?
That's how it works, TK. We'll get you the latest update on the UAW negotiations a little bit later this hour. Let's turn to the price action on the S&P 500 this morning. And good morning to you, up by 0.2% on the S&P. Yields pulling back just a little bit. We're down 2 basis points on a 10-year to 4.34, but had a little look at cycle highs in the last 24 hours. And Lisa, if you want to blame something, I guess the move started after Canadian CPI.
Yes.
This was down to Canada, apparently, in yesterday's session.
And it came in lower than expected, kind of similar to what we're seeing in the UK. Today, the focus really is going to be on that 2 p.m. FOMC rate decision, followed by Fed Chair Jay Powell giving that press conference. The forward look, the statement of economic predictions, the dots. The concept there is what people are really going to be watching. A hawkish pause. God, we're going to have to be talking about that in the band that Tom created in high school today.
Is this 6:30 p.m. tonight? Are we into the surveillance sleep, or are we doing this?
We're doing this. We're going to be here.
Yeah, my people haven't told me.
A Fed special is happening.
1:30 p.m. Eastern or 6:30 p.m. British time. Meanwhile, today, Bank of America CFO Alistair Borthwick is going to be speaking around 7:15 a.m. Eastern time at a Bank of America Financial CEO conference. JP Morgan CEO Jamie Dimon speaking at the Detroit Economic Club at 1 p.m. I am curious how much they indicate that this strength has further room to go, and the savings cushion. Do they push back against that at a time where it seems like people are getting raises and can actually push forward?
I'm interested in the fact it's in Detroit. Just kind of timely, right?
President Dimon, do you think that he's going to be trying to do this?
I'm not saying that. I'm just saying it's a timely conversation,
it is,
given what's happening.
How much is he going to weigh in on this? He's been known to be rather blunt, so it'll be interesting to see whether he comes out. In aftermarket, we do get some earnings, including from FedEx, which has gotten a boost so far this year from Yellow and UPS and some of the union negotiations there. I'm curious what they say about their labor and potential negotiations.
Always important.
Lisa, thank you. Joining us now, Ben Laidler, Global Market Strategist at eToro. Ben Laidler, constructive on this equity market. Max Kettner, HSBC, sat in your seat yesterday. He said we need to think about what could go right next year. You're the master of what could go right. What could go right?
Wow, you want me to give you the whole list?
Is it that long?
Listen, we're living sort of Goldilocks macro, right? I mean, growth is a lot better than we thought it was, and core inflation, it continues to fall, and I'm pretty comfortable that that's going to continue. That has taken the biggest risk off the table, which I think has given the rally you've seen this year, which is that the Fed was going to have to keep hiking whilst inflation was sticky and sort of drive us into recession. That's now gone, and the earnings cycle is now turning up, and it doesn't have really very much to do with the real economy. It's very tech-led. Inflation is now falling enough to take the pressure off profit margins, and probably the third and least important one is that the economy is sort of hanging in there. So looking forward to next year, which I think is going to drive this sort of fourth quarter rally, is return to double-digit earnings growth, and the Fed and, frankly, the rest of the world beginning to cut interest rates and keeping valuations high.
I want to go back to your process, and he mentions Max Kettner of HSBC yesterday, which I think the dovetail here is really important. You say right now the wall of worry remains high. You are the ultimate anti-gloomster out there. In late 2018, I believe it was, what was your process to push against the wall of worry then? What's the Laidler process to stay bullish and resilient?
You just got to look at what really matters. I mean, there's always a wall of worry by definition. The day there isn't is when we're all just, horrendously complacent and we're about to sort of trip over our feet. But, that wall of worry is huge right now. I mean, we're worried about bond yields at, 4.3, 4.4%, even though we're getting no validation from break-even inflation. We're getting no validation from sort of copper prices. This is classic US sort of exceptionalism. UAW strike, so a third of US manufacturing is autos, but we probably need a bit of a slowdown right now. And you could say the same about, potentially a government shutdown. It's an unorthodox way to slow the economy, but hey, maybe that's what we need right now.
Okay, everything that you just said, and I specialize in worry, would make me very worried. And I will tell you that person after person has come on this show and displayed an amazing display of lack of worry. Not only that, but you can see, yes, exactly what you're saying. Yields are high, and people have seemed to be shrugging it off, saying that we have already seen the bulk of the effects of monetary policy tightening. So doesn't any of this stuff catch your eye and make you think that maybe we could see some of those lag effects pick back up next year?
Yeah, totally. This is as good as it's going to get for the U.S. economy. I mean, the nowcast, the Atlanta Fed is nearly 5%. Unheard of. That's absolutely going to slow from here. The impact of 5% Fed rates is coming. It's just delayed because, corporates have refinanced and mortgage holders have 30-year fixed rates, but it is coming, and the slowdown will come, except it's a soft landing, it's not a hard landing.
So are you saying that slowdown has already been priced in, or do you see that actually coming in the prices in certain pockets, albeit not big tech in the US?
I think it's more a sector argument than a market argument. I mean, why am I not jumping into growth cyclicals to small caps? And the market is sort of nibbling at them, but they're not running away with you, and I think that's your biggest tell, that the market doesn't think that this growth story is sustainable. This keeps me in sort of long duration. I know some of these long duration assets, have been have been a tough slog. But, I do believe the underlying pressures of inflation continue to ease. Growth will slow. The laws of economics are not broken. And therefore, stay long tech, stay long bonds, stay long these long duration assets.
Stay out of Europe?
For now, but I think Europe's going to be the surprise next year. I think, Germany is pretty miserable right now and is leading Europe into recession, but give it 6 months and I'm sure we'll all be talking about the German recovery and, how that cyclicality works both ways.
Is that an FX trade or an equity trade?
I think it's probably an equity trade. I think central banks are super interesting. I mean, the Bank of England's about to go on hold. That leaves us with 3 of the top 4 central banks in the world on hold, waiting for the cut, which will take a while, but it'll come. And then, this weird outlier in Japan where they haven't even started hiking yet.
That's a story for Friday, TK.
I noticed, and John has been very good on this, for example, the luxury pullback. Bernstein was out today saying in some ratios, luxury is already back to 2008 levels. Have we had a correction, even if it's not a market SPX correction? Have we had in certain sectors substantial enough correction where you say, wow, there's value?
Yeah, we're definitely seeing it. And, the consumer is not sort of homogeneous. I mean, we are seeing, you mentioned Amazon earlier on. People are shopping online. They want to save money, and they're not They're shopping less for luxury. They're shopping less in department stores. They're buying less big ticket, so credit-dependent items. So, there's a lot going on under the surface here. But and you're seeing that play out in luxury. And, LVMH has been dethroned as the biggest stock in Europe.
In a Laidler bubble, what are you hearing from institutions? Are they buying the Laidler optimism, or is everybody under the table at Claridge's hiding out in 40% cash?
I think institutions have been late to this party, have been late to the rally. I think everyone else, whether it's corporates or retail, has been out front or never gave up.
Why is that? Wait, the institutions are the smart guy, right? You told me that, John.
I never said that. They're called the smart money.
Why are they behind?
Good question. You'd have to ask them. But I think sentiment's moved a long way. I don't want to say everyone's bearish, but to the extent people are bearish, it's sort of long-only institutional managers that I think have been very late here. And and one of the reasons I think you got a fourth quarter catch-up, right? I think people look at that year ahead and think, do I really want to be carrying 5% cash?
That's the classic Laidler charm there. Why he's beloved, long only buy side.
So one thing that you said in there, Ben, and this kind of feeds into tomorrow and the Bank of England, you said they're going to be on pause. And that is essentially what people had interpreted with today's lower than expected inflation read. Is that basically what that means? That anything that comes in disappointing, the balance of risks is, oh God, we can't do anything.
I think they're going to do a sort of 25 basis point last insurance hike, and then they're done, right? To your earlier point, I'm not cracking the champagne open that inflation's only at 6% in the UK. That still leaves us with, the highest rates of any market we want to be compared to, and the highest inflation of any market we want to be compared to. But, it's a step in the right direction. Markets trade on the incremental data point. They're going to watch and wait, right? Everybody's data dependent. If the numbers, don't come through, then, maybe there's another hike there. But I think the base case is one more hike and they're done. That's
tomorrow's story. Ben Laidler, thank you, sir. of eToro. Later on this afternoon, the Federal Reserve. Front page of the business pages here in the United Kingdom. Rishi Sunak, the British Prime Minister, under a little bit of pressure, supposedly because he's about to push out the ban of gasoline vehicles, Tom, back to 2035 instead of 2030. The first question I had this morning, reading the pages, who's next?
Yeah,
it's the reality check for Sunak and for pretty much everybody else. And this transition's going to take longer.
I think it's almost our secondary theme on this Fed Day Wednesday because it's just so important to see the retreat of elites in the United Kingdom. Granted, it's take the x-axis out. I don't see any concept retreat. But you wonder what's behind it if the people still say, you're kidding me.
On a practical level, the policy uncertainty for big auto manufacturers just continues. I mean, Ford came out and said, wait a second, whoa, we're making this huge investment on electric vehicles. You got to stay the course with all of your incentives and your plans. This is a very tricky thing.
Do we want, there's a lot of electric vehicles in London. That's my observation.
They're expensive, Tom. They're expensive.
Yeah. I mean,
how are we having a conversation about a cost of living crisis at the same time as trying to get people to
totally
buy
agree.
67, 80.
I mean, those cabs cost a fortune. Those Chinese cabs made in Coventry.
Patrick Armstrong of Parimi Wealth coming up in the next hour. Your equity market positive from London. Good morning.
I don't think this one's going to be a major oil spike either. I think we are going to find that the demand responds pretty quickly to these price hikes, and it slows down, and oil prices come back down, not dramatically, but at least they stop going up.
Yardeni Research President weighing in on this crude rally in the commodity market this morning. We're negative 0.8% on Brent. We're down more than 1% on WTI. The call on this program earlier this week, and read a set of energy aspects looking for triple digits in the next couple of months. Equities right now going into that Fed decision shaping up as follows on the S&P 500, positive by 0.2%. Yields a little bit lower, backing away from cycle highs on a 10-year, 434.27. We're down a single basis point. And there's that move in crude, Tom. $90.22.
Maybe back a little bit, $1 or $2 or whatever, but still elevated to say the least. And then there's 18 shades of crude above that, including Brent crude, the global price. Because of time, we're going to get right to this. When Javier Blas walks into a room at some confab of the great and worthy stop. He is encyclopedic on global oil. His book won all sorts of awards, The World for Sale, and he joins us here with his great effort for Bloomberg News. Javier, my book of the year is Robert D. Kaplan, The Loom of Time. It's about the greater Mediterranean on out east to Afghanistan. And the single best chapter in it is Kaplan's huge clarity on the Saudi Arabia we think we know, but it's not the Saudi Arabia of our youth. What does the new Saudi Arabia look like in terms of oil? What is MBS doing on oil that we need to know about?
I think that when you think about the new Saudi Arabia, you could just think about two words that many leaders in Saudi Arabia use today: Saudi first. And that really shapes oil, shapes geopolitics, shapes power, shapes the economy. Every decision they're going to take is going to be thinking about what matters for Saudi Arabia, thinking about Saudi Arabia first. And on that sense, they really want to keep prices as close as they can to $100. They say they don't target oil prices, and well, the truth is they do, of course, target oil prices through supply, demand, and inventories, and they're trying to keep prices as close as $100. That's what is good for Saudi Arabia. That's why it comes Saudi Arabia first. Do you see in all your work, and particularly looking at their marginal desire to stay at $100, that will reduce demand? If we have $8 gasoline, petrol in the United Kingdom, if we have $5 plus petrol in the United States, does it reduce demand? It will reduce demand, and obviously it could contribute to higher inflation, higher interest rates, and therefore lower economic growth. So the Saudis are playing a very difficult game of how high they can get without triggering the negative consequences. So far, it has been good for them. Demand seems to be holding. There is a lot of talk about weaker demand, but in the reality, it's like this recession in Wall Street that has been coming for the last couple of years. In reality, demand is fine. We are at 103 million barrels a day. That's an all-time high. Demand has increased year on year by about 2 million barrels a day. That's historically very good. 2024 is a bit of a question mark. The Saudis are running into risk, but so far it's working for them.
Are you suggesting they have a higher tolerance for economic stress abroad now?
I think so. I mean, in the past, the call from the United States will have already been made, and the Saudis will have acted, and it will have not really led the oil price to go much higher than $100. And at the moment, they're just not picking up the phone the way that they used to Washington, because they are putting it all and foremost their national interest first. So yes, I think that if the U.S. is suffering, the Saudis are going to say, well, you need to do something about it, then we can help later.
What do you think underpins that change? That breakdown in that phone call that used to happen between the White House and Riyadh? I think that above all, the Saudi Arabia needs the money. If MBS, Mohammed bin Salman, the Crown Prince, wants to transform the Saudi economy, he needs the money. So it's not international politics, this is finance? I think it's just finance, and I think it's a lot of it is national politics. It's about what the Saudis need. I was in Riyadh earlier this year, and I was in the outskirts of Riyadh. There is a new capital emerging, it's Al Diriyah. There were 60 cranes, construction cranes. That is costing a lot of money to the Saudis. Which raises a question. If they're really looking for targeting that $100 a barrel, does that mean that oil prices can remain high even without the growth to underpin it? That basically Saudi Arabia will cut production enough to achieve that regardless of the backdrop?
No, I think that the commodity cycle and the economic cycle is always going to play a role. And if the global economy weakens next year, then the Saudis are going to have to accept lower oil prices. They already cut production significantly this year. They are producing 9 million barrels a day, which is relatively low for historical standards, at least for the last 10 years for the Saudis. And that in part was to accommodate a huge increase in Iranian production, very quietly, not making much noise. But Iran is this year the second largest source of incremental oil supply into the market. So the Saudis have accommodated that. They cut production. I don't think that they can continue cutting production even deeper into 2024 if the global economy weakens. But certainly they are going to try to keep oil prices as close as $100 as they can. And let's not forget, for Saudi Arabia, on Arab Light, which is the benchmark that they care, the price is already at $100.
There's also a question about other areas of production, in particular the U.S., which has been serving up a record amount of production. There has been question about how much that can increase. How much is that a swing factor that could materially alter the price going forward?
It is a massive swing factor. We have seen at the moment that the price of WTI, West Texas Intermediate, has gone above $90. We have beginning to see an increase in the rig count in the United States, but clearly there is a question mark whether we are going to see more U.S. production. At the moment, what we are beginning to see is a plateau.
Javier, I want to be very quick here. We're in Davos, the great and worthy were assembled. Javier Blas walks in, the room falls silent. At the table next to you is Savita Subramanian of Bank of America. Folks, she lifts her S&P call today. Subramanian was ordered by Brian Moynihan to do ESG. She did brilliant mathematics on ESG. Is there a new ESG? When you see Sunak in London capitulate, when you see what happened at British Petroleum, is there a new ESG out there?
I think that we saw peak ESG about 18 months ago. I call it a bit the ESG bubble, and reality is starting to sink in. We have seen Prime Minister Sunak watering some of the commitments on net zero. And I think that we are going to begin to see more leaders. It's difficult to meet net zero. It's going to be costly. The easy part, the low-hanging fruit, has been done. Until now, it was all win-win. It was green and cheaper. Now it's just more difficult. It's a lot of trade-offs. It's going to be green, but a bit more expensive. And we have not yet had that conversation with the voters. We said to everyone that this was great. It was going to save the climate and bring prices down. Now it's a much different conversation. I'm not saying it's wrong, but it's a different conversation.
It's changed big time. The question I asked this morning, Javier, who's next? Who's going to push out some of these targets?
I think that we have already seen Japan within the G7, and I think that Germany and France are really on the fence.
Yeah, Javier Blas of Bloomberg. Javier, thank you. Just some news coming out of the UK. This from Goldman. UK interest rates have peaked. Their line reads as follows. The BOE likely to keep rates on hold tomorrow. Consensus for tomorrow was a hike from the Bank of England, 25 basis points. We spoke to one guest who suggested you get a hot print, they might be going to 50. Maybe now, Lisa, after that downside surprise, this Bank of England backs away. That's the call Goldman is making this morning. Which
is the reason why the pound is softer versus the dollar. But if you think about it, this is kind of counterintuitive, because if you think inflation is actually coming down, shouldn't it be stronger if that actually gives more of a pass? I mean, this is where the currency differentials are really kind of raising some questions.
I guess this morning, at least, the explanation is you lose some of that rate support. You've got the two-year yield down by about 13 basis points, Tom, and sterling weaker off the back of it.
Yeah, and some of the forecasts out, you follow more than I do, John, because you're paid in sterling and you really care about it. But the answer is we're down to 120, and we had somebody the other day. We had somebody the other day talk parity. You turned white.
Parity on euro dollar, not on pound sterling against the US dollar. Yeah.
I mixed my pairs.
Different.
Thank you.
Different currency pair, TK. Elsa Linos will straighten things out of RBC on the FX market. Elsa's going to be joining us next. Your equity market more broadly on the S&P, positive here by 0.2%. Your Federal Reserve decision a little bit later for the Bank of England tomorrow. Goldman Sachs says no hike. New price target at Bank of America, 4,600. Savita Subramanian, the upgrade, up from 4,300. Right now, equity futures positive by 0.1%. More on that upgrade a little bit later. On the Nasdaq futures positive here by 0.14%. A sleepy Snoozy starts to the week. Several central bank decisions coming up a little bit later. The Federal Reserve this afternoon. Bank of England tomorrow. A feeling that things have changed over at the BOE, given that inflation print a little bit earlier this morning. Goldman first out the gate to say we are done. No hike coming tomorrow morning. More on that a little bit later as well. Let's turn to the bond market. 2-year, 10-year, 30-year. 2-year yield in America in the Treasury market still north of 5% and very close to cycle highs. On a closing basis, a new closing high, a new cycle high on a 10-year, just short of that now, down about a basis point or two to 434.27. I just want to finish on foreign exchange, turn to the euro just briefly. The euro shaping up as follows against the dollar, 107 and positive by 0.2%. That's the cross-asset price action. Under surveillance this morning, the Fed expected to hold rates at today's 2 p.m. Eastern decision. However, investors waiting on clues from the so-called dot plot and economic projections as a tight labour market and crude prices add to inflation pressures. Chair Powell's news conference kicks off at 2:30. Our coverage begins at 1:30. Might as well bring you the lineup. Stacked show, TK. Kathy Jones, Charles Schwab, Matt Lazzetti, Deutsche Bank, Diane Swank, KPMG, Citi's Andrew Hollenhorst, Citi, alongside Mike Gapin at Bank of America, believe. We've got one more to come here, and that one more comes in November.
What's important here is some real eclectic calls, not only on the real economy, but also on the rate guess that everybody's making. I'm fascinated, as you mentioned, Supermanian in the equity market, how people are amending, and directionally to see Hollenhorst come in would be important. We haven't seen that yet.
Let's turn to UK inflation, falling to the lowest level in 18 months ahead of the BOE decision on Thursday. CPI coming in at 6.7% year over year versus the 7% expected. Sterling weakening to the lowest level since May as traders pare back hike bets. And that paring back of hiking bets, Tom, goes to Goldman Sachs. Goldman say we've peaked. Goldman say no hike tomorrow.
For a U.S. audience, what's important here is to triangulate. And like euro-yen, we across the pond have you triangulate to euro sterling. They're both weak versus the U.S. and that tug of war. How does that play out, John? You follow this day to day.
So Lisa raised this question, and I think it's a really important question. Should sterling be rallying off the back of no more hikes, given that we might not damage growth anymore? And I don't think the answer to that is as obvious as you think. This morning, it's fairly intuitive. You lose some of that rate support. The front end of the curve rallies. We're seeing that in the UK 2-year, and sterling weakens off the back of it. But do we have a better outlook for growth off the back of a Bank of England, Tom?
Well, that
might be done.
This is the ambiguities. And, you know, Matt Lazzetti, just as one example, with us this afternoon on our coverage, he said, yeah, there's going to be a slowdown, but his brilliant call was to push it out from his original call. He said this is out a long way out, and we're still waiting, and we've been wrong on a UK slowdown. You look at something like the GDP input to Newcastle of that game last night.
I'm not talking
and
about
that moves
that game
the needle up.
There will be no conversation about that
There'll
game
be no
last night. We're done with that.
What else do
you
we
get any
have?
Instacart shares? Did you get any shares?
No, I did not. You got your usual 8,000.
Instacart easing in this morning's trading after gaining as much as 12% in Tuesday's debut. The IPO raising $660 million, marking the year's 4th biggest public offering in the United States. Semiconductor designer ARM raising $5.2 billion last week in the biggest listing of the year. Can you take any signal from this, TK? These two listings we've had in the past week?
I believe it was Zero Hedge. Had great charts last night. ARM goes up, enthusiasm rolls over, and it sells back to the initial opening price. And for both of these companies, very different. You know what it's about? The first conference call. That's really what this is about. You get away from the hoopla, and you get out the first call, second call, third call. And then
those quarterly earnings.
Quarterly earnings.
Like the questions from the analysts.
Do you think they understand they've got to go on the phone and explain what's going on?
I think ARM understands that. Instacart might have to figure that out.
Yeah.
ARM's got a history of doing that, Tom, as you know.
That. We are having fun today. It's an extended day for us here in London. It's been wonderful. Our team's put together a great eclectic set of voices for you to frame out, the path to 2024. Elsa Lingos is hugely qualified. Global head of foreign exchange strategy at RBC, tour of duty, working in Europe with different institutions to look at the political economics of the moment as well. You know, to you, I can say, like, what's Euro going to do or what's Sterling going to do? What are they going to do if they actually get disinflation? Can you call a disinflationary trend in place yet?
Too soon for that. But I do think this morning's CPI data will be very welcome news from the Bank of England perspective, because they'll feel like finally their policy measures are biting and they're removing some of that tail risk of stagflation.
How many months or quarters do you need to establish a disinflationary trend? Not the data dependency, the media's focus on one surgical point, but what's your timeline to say trend in place?
Well, I think it's also the composition of inflation, right? Because we've seen headline inflation come off on energy prices. In fact, if anything, now ticking back up again, as we saw yesterday in Canada. So really what we're focusing on is that core measure, or even more so the super core measure. What's happening to those demand-driven components of inflation? And are those weakening enough to signify that we're going to get to target?
And Paul Krugman with a brilliant essay out, folks, wheelhouse for the Nobel laureate on trends. He looks at disinflation, and I love what he says about plain vanilla inflation. John Farrow's family in England is living plain vanilla 6% plus inflation. Do people like you and these elites, do they look at plain vanilla inflation?
I mean, you see plain vanilla inflation across the board, right? And I think that's the important part about the current rise in energy prices. Because for all that central banks like to look through those and focus on core inflation, if headline inflation goes up, comes down a bit, goes up again because oil prices or commodity prices don't really come off, what does that mean to your average consumer? Their kind of lived experience is that prices just keep going up.
I can't believe we're sitting here and we've got this note from not the Bank of England, from the Goldman Sachs team on the Bank of England, suggesting we're done here when inflation is in the high sixes. Can you make sense of that for our audience? If we were in the high sixes in the United States, we'd be talking about the prospect of a 50 basis point hike from the Federal Reserve this afternoon. Why are we talking about the Bank of England being done with inflation in the high sixes and wage growth pushing 8%?
I think it's the wage growth that's more important, right? Because don't forget, the Bank of England looked through high inflation in the immediate aftermath of the GFC. And there was a long period where Mervyn King was writing regular letters to the Chancellor about inflation being outside the target band, and yet, you know, they were happy to leave it whole near zero. It's that which is the difference. It's the fact that they're happy to look through it if they feel like their policy is working. And I will say this morning's data do make tomorrow's decision much more finely balanced.
Simon French of Panmure Gordon was in your seat yesterday. He suggested that this Bank of England has a communication problem, a credibility issue. Do you agree?
Yeah, it's hard to say they don't. And I think more than anything, it's the inconsistency in the messaging that people struggle with. I mean, sure, this is a particularly difficult time to be forecasting. I think economists have struggled with that on the sell side and the buy side. But from the Bank of England's perspective, it's the fact that that message seems to change every month, rather than just sticking to this data dependency mantra.
You speak 14 languages. You've got parchment and physics from Cambridge. I want you to talk about the physics of Christine Lagarde's speech at Jackson Hole. You've lived the ECB theory, the ECB process, if you will. Is there any hope and prayer that the ECB can get away from the data dependency that she despises?
Sadly, not really. And I think the reality is that you've got so many competing views on Governing Council. You saw that just over the weekend, right? They had that announcement last week, and then they already came out with voices saying, oh, we should be doing more, we're not quite done yet. And it's that kind of cacophony of voices which ends up with the data dependency.
Well, you two are expert on this, John. You've lived it as well as Elsa. And what I find fascinating here is the simplistic American view of Bundesbank versus Portugal. Now, it's not that way. You both know it's richer and more complex. To be honest, my good friend Christine Lagarde doesn't have a chance on this. There's no chance that they're going to take a more holistic, longer Philip Lane trend.
Here's the difference.
In policy.
Under Draghi, who was not a consensus builder, he would bully the Governing Council into a corner and say, we're doing this. And he'd have to get the Bundesbank to come along. Lagarde is a consensus builder, but she gets an easy time of it now because Germany's the weak spot. Germany's the weak spot.
Do you agree with that?
And what I don't hear from the hawks on the Governing Council, they're not screaming rate hikes. They're not screaming rate hikes at all. So how much of a deal was there actually to strike on the Governing Council last week? People make out there was a deal between doves and hawks. The hawks that I'm hearing from aren't that hawkish at the ECB, are they?
Well, they're a lot less hawkish than they used to be because, as you say, Germany itself is feeling the weakness. But also Draghi, in many ways, had to do that, right? Because it was a crisis situation and that forced his hand. Whereas now, we're not really there. We're kind of in a situation where central bankers have a bit more time to assess, to be data dependent, to build that consensus.
I teased this a little bit earlier when we were assessing what was happening with sterling. And Lisa raised the question, I think it's a really important question to ask regarding the UK and sterling, but I think we can take this broadly to Europe and the euro. How important are rate differentials for currency pairs at the moment? When you see developments in the UK, is this kind of development meant to be sterling weaker or sterling stronger? What does it mean?
Fully agree with Lisa that it's ambiguous. right? I've heard a lot of people, probably more from the sell side than the buy side, trying to talk up sterling as this carry trade. There's much better carry out there. I mean, if you really want carry, you're going to Mexico, you're going to Brazil. Like, the UK is not necessarily where you're going to get it. But at the same time, the fact that, like I said earlier, you kind of remove some of that tail risk of stagflation, that's a good thing. And from a policy credibility perspective, it's good that the Bank of England is finally seemingly getting inflation under control.
What is your question for Powell today? You're in the press conference. McKee gives the last question. They go, Lingos, you're here. We'll give you one. What's your question to Jerome Powell today from your EU perspective?
I'd be really interested to hear how he's thinking about the run-up in energy prices and the feed-through that will have to headline inflation.
Well, wait. Well, stop the show here. Halima Croft. Okay, you've got someone who's pretty good at this, right?
Yeah.
What does the wonderful Halima Croft... Halima, wonderful to see you. Thanks so much for stopping by. Halima Croft, what does she say about this move to 100?
I think she's been bang on the money with that call. Now that we're there, it becomes a lot less obvious that we continue further from here. But she was very open and talking a lot about it earlier in the year, and markets were just ignoring it for a while. They were ignoring the supply cuts, the production cuts. We're here now. We feel the impact.
Can Powell ignore this later on this afternoon?
I mean, let's see. It's a very short intermeeting period between September and November. December is probably the time they need to make that call.
Do you think the Bank of England can ignore it a little bit more? I'm just wondering, who is this more important to? Governor Bailey? Ueda? Powell?
Ueda we can almost forget about. The Bank of Japan are not doing anything anytime soon, and even when they do, it's going to be tiny. Now, I'd be most concerned in the ECB's position. Energy importer, you still have that regional difference between US energy prices and European, and they're the ones really that are facing the economic weakness.
We are staggering beyond Duesenberg. Through Trichet, John mentions the wonderful Draghi of Italy and now Lagarde. Is the ECB a more mature institution now, or are they still making it up as they go, as they did when Maher Singh was there?
And absolutely more mature. And, you know, you've got to remember they've been now in existence for over 20 years. They've been through several crises that's knitted them together. But more than anything, the fact that it's the core now feeling the weakness, I think that
John mentioned that.
Naturally brings
I didn't
them
mention
together.
that. John mentioned that.
Jane Foley talked about the prospect of parity on the euro in the new year. Are you going there yet? Can we finish there?
Come, we got ECBs. Come on.
We've had 104 for year-end forecast since the start of the year. And that hasn't changed. But we looked into 2024 and actually said, why should it stop here? Why should it bounce back? We've got 102. Could we get to parity? Sure, maybe. I just don't think we'll stay there long.
Okay. Bold. Elsa, thank you. That's quite a call so far in the year. We'll see how we end it, but quite a call so far. Elsa, thank you. Elsa Lingos there of RBC. They've got 104. We're trading at 107. 104 was quite a call at the start of the year. You have to imagine. Go back to the start of the year, all the happy talk around China reopening, what it might mean for Europe and TK. That story is not the story going into year-end. In fact, Lagarde talked about that in the news conference of the ECB just last week. The tailwinds at the start of the year, China reopening, lower energy prices, they have gone and they have developed into headwinds going into year-end.
Yeah, and I think into these 3 central bank meetings, what our audience needs to pay attention to is this is a movable feast right now. There's no cast in stone belief going into October, dare I say, to that Fed meeting in December. We're literally, John, making it up as we go. And it feels that way, folks, putting the show together. Day by day, we're making it up.
Day by day. I think we can say the week begins today, a little bit later on this afternoon. Chairman Powell, decision from the Fed, non-decision for many, no change expected. The forecast will be closely watched, changes to growth projections, inflation, the dot plot as well. Then it's on to the Bank of England tomorrow and the Bank of Japan on Friday. To preview all of that, Bruce Kasman, JP Morgan, looking ahead to those 3 central bank decisions. He joins us next, live from the City of London for our audience worldwide. Good morning. Three big days coming right up. The Federal Reserve a little bit later on this afternoon. The Bank of England tomorrow. Then on to the BOJ, the Bank of Japan, and Governor Ueda on Friday. The price action set up as follows, going into all of that on the equity market. Futures, just a little bit positive here by 0.2%. Yields coming in, TK, a couple of basis points. Your 10-year, 433.
The price action here that matters is, can John get decent tickets for Arsenal Tottenham on Sunday? What do you think?
I'm trying to hook it up. Arsenal's the home team, though.
What I find,
Tottenham.
this is the only city in the world where I religiously take taxi cabs. I love them. If you mention English football to anybody driving a taxi cab,
Yeah, they've got a team.
That's entertainment. That's entertainment for the whole trip.
I prefer the West Ham fans.
Yeah.
The West Ham fans, proper East London cab drivers who have got things to say about British football.
I've had so much fun with this. We're going to pause on this right now. Bruce Kasman coming up here in seconds on an important day, important conversation with Dr. Kasman. I had so much fun last night following a boring 0-0 game. It wasn't boring. What is the symbolism that Newcastle went in there and survived AC Milan?
Pretty impressive. They've not been in the Champions League for about 20 years. So to go to a stadium like that, and for some of those players, Tom, they probably never thought they'd be playing an occasion like that.
To walk in a field like that,
stadium
yeah,
like
very
that.
cool.
To walk out to 80,000 fans, and we talked about the atmosphere and the acoustics of the San Siro, to survive that. And they did survive an onslaught. Compared to the shots on target at Newcastle, I think one
Oh, it's
for AC
terrible.
Milan.
It's completely one-sided.
Completely different in terms of the statistics. But yeah, they got out of it alive, and fair play to them.
And just to educate idiots like me, they do it again at Newcastle.
There will be a return leg. I think that return leg is in December.
Yeah.
But the challenge you've got, TK, when you're new to the sport, is understanding the tension of European football, understanding the tension so that you can enjoy.
Is it
when
nationality
they don't
in
score.
cities and, you know?
Yeah, the tension between the two clubs.
I
but
don't
also
see
the
it
tension
anywhere in
within the game
America.
itself.
Anywhere in America. Maybe NBA, but not even there.
I was always told that Americans didn't like European football because it was too slow and low scoring. And then I look at American football, Tom, and the ball is hardly in play.
Oh, they've ruined the game.
And all you've done
Don't
is
get me going.
call 1 goal, 7
Yeah,
points.
yeah.
What's the difference?
It's run by committee
I'm going to get
now.
so much hate mail a little bit later
No,
on.
but what's
that.
important on this, and this is the change, what we hate about English football is everybody falls down and gets hurt. And they've really diminished that.
They need to clean that up.
They've cleaned that up.
And I think the officials, the referees, are going to try and
Yeah.
do something about that.
There's your football moment for the day. We're having a lot of
We
fun
are done.
here in
No more
England
Newcastle AC Milan.
doing
No
this.
more of
As
that.
John mentions, the week starts today. For Bruce Kasman, it does not. On Friday evening, Kasman, along with the dreaded Dr. Ferroli and others, put out their weekly prospects. The way things are moving, it could be daily prospects. Kasman of J.P. Morgan joins us this morning. Bruce Kasman, what will you listen for from Jerome Powell today?
Well, I think the issue really when the Fed certainly stays on hold and certainly also continues to maintain a hawkish bias is how on this color are we talking about their confidence that they're done here. And I think, of course, they're going to continue to maintain that bias. They're going to give us some sense of progress on inflation, some ongoing concern. I don't think we're going to get a strong message. And quite frankly, I don't think it's going to tell us that much in a world in which the data is going to decide what the Fed is going to do over the next few meetings.
Our optionality, our ambiguity, our degrees of freedom, and all the other mumbo jumbo buttresses up against Michael Ferroli's arch call on potential GDP. That goes into our start. Do you have a low statistic on potential GDP? Does that give you a low R-star, that goal that Jerome Powell says he's trying to get to?
Well, I think there's two things here. One, which is perhaps most important, is potential GDP is low, but cyclically there are a number of forces which have raised what interest rate is consistent with stabilizing inflation and stabilizing utilization rates. So I think that's what's operational for the current environment. The second point, Mike and I have both been writing about the hints that U.S. supply side performance is actually improving. We've been running 250,000 a month on labor supply this year. Productivity growth, which has been stuck in the low ones, looks like it's moving higher on an underlying basis. It's too early to get confident about this, but it does feel to us that U.S. supply side performance is actually improving here.
I know you and Bob Michael aren't on speaking terms, but just the few times where you've got to get together and dovetail your economics into Bob Michael's fixed income, which I believe is price moving against yield. Can you make a yield call here? If we get Kasman disinflation, do yields come down?
I think it's going to be a while before yields come down. If we're right, inflation is going to stay sticky here. The Fed is not going to have the room to ease anytime soon. The economy is not really at material threat of going into recession anytime soon. So I think, 4% 10-year yields, 5.5% policy rates is going to be with us for a while.
Bruce, you touched on it, and I think it's a really important aspect I mentioned of the Federal Reserve conversation today and into this decision and news conference, the extent to which this labour market has rebalanced. Do you think that rebalancing is close to complete then, Bruce?
No. We have a very tight labor market. We still have very elevated wage inflation. I think we're seeing good signs on the labor market that things are moving in the right direction. But whether we get all the way back to what is consistent with the Fed achieving its inflation target, I think is still not by any means determined. From my point of view, I think it's more likely that things stick at a level that's going to keep the Fed uncomfortable over the next year.
Does that mean low unemployment with elevated inflation, or higher unemployment with elevated inflation? Because one mix is a lot more toxic than the other.
I think it's most likely the unemployment rate stays below 4%. I think it's most likely that wage inflation stays at 4% or higher. I think it's most likely in that environment the Fed is not going to have the opportunity to ease. And the question is whether or not that restrictive stance over time undermines what is still a pretty healthy U.S. private sector and eventually causes an end to the expansion, or whether the supply side improvement, whether some of the other supports can carry us along here and put us on a path to a soft landing. I'm in a boil the frog scenario, which is the first one I described, but I think it's still a pretty close call here as to how the environment plays out over the next year or two.
I mean, Bruce Kasman, what's so important here is simply there was a pandemic. Are we beyond the pandemic? Are we beyond supply side studies where we're getting back to Kasman 101?
Look, I think we're beyond I hope we're beyond the pandemic in terms of its impact, direct impact on economic activity. But I think there's two issues here. One, we're still in an unwind of some of the pandemic dislocations. That's what inflation coming down is about. That's what some of the normalization going on in service sectors are about. We're not quite done with it. We're starting to get closer to the end. And then we're dealing also with the reverberations of this pandemic on a more lasting basis. And a couple of them are the damage done to the supply side globally. And I also think the health of the private sector balance sheet, which is a really weird thing to say, comes out of such a bad event as a pandemic.
Bruce, let me expand on this with one thought, and you pick up on it. Can China export disinflation or a deflationary trend? What does JP Morgan see of domestic China exported out across the world?
I think China is exporting deflation and goods pricing to the rest of the world. Chinese production is picking up right now. You see import prices in Europe and the U.S. from China going down sharply. We think global industry is starting to pick up. China's benefiting from it. So I think the Chinese economy is going to be weak, but not hit the fears, I think, of a real disaster that people expect. I think global industry is picking up. I think China is going to keep a lid on global goods price inflation, as among other things, for a while, except, of course, for what we're seeing in oil.
So, Bruce, just before you go, I've got to do a little bit of housekeeping. The takeaway from this conversation, high for longer, got all of that. Can we just play with the dot plot a little bit and get out to 2024? What do you think that dot plot will look like later on this afternoon?
Well, the most important is probably 23, and it looks like you're going to have a divided committee. We're on the side of them still having the median voter with a dot, but it's a close call. I think regardless of that, and regardless of big changes in the forecast for 23, the 24 forecast is still going to have something close to 100 basis points of easing. It's still going to have a big drop in inflation. It's still going to have an aspiration that we get an unemployment rate up to 4.5% without a recession.
And you don't buy it, Bruce?
I'm skeptical. I'm not pounding the table on it, but I'm still skeptical we can heal here without more damage being done to demand.
Bruce, thank you, sir, for the update from JP Morgan. Bruce Kasman there on the outlook. The takeaway here, Tom, high for longer. There was an interesting word that Bruce just used, aspirational.
Yeah, that was absolutely brilliant. And the best part about it is John asked the correct question. I don't give a damn about the dots, folks. And thank God Ferro brought up the dots, because a lot of our audience, and particularly Global Wall Street, cares.
They care about the dots. Patrick Armstrong, Plurimi Wealth. He joins us next. Equities up by 0.2% from London. This is Bloomberg.
The doesn't look like we've got a major issue with the economy at the moment. The economy's been relatively resilient.
Central banks have carved out in the last 6 to 9 months a focus on core inflation.
2024 should be a better year for earnings with the market.
We are seeing inflation coming back down towards where the Fed would like it to be.
In the end, higher for longer means there's going to be further tightening here in the real economy.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
The Fed decision a little bit later on this afternoon. Live from London for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Bramo just stepped off. She's going to be back a little bit later. In your equity market on the S&P 500, we're positive here by 0.2%. A lift to the equity market, TK. Hours away from Chairman Powell, that press conference, and all those lovely forecasts you look forward to, including that dot plot.
The dot plot, can't wait to see that, Jewel. What I'm going to look at is the dot plot that is the voice of the Standard & Poor's 500. John, rounded up 4,500. It's showing a resiliency. It's an equity market, big amount of money that's saying they believe in the Fed, they're going to get the job done, and they need to be in equities. And you wonder at the margin, like Savita Subramanian
She's
today,
on board.
Going on board, and others, Ben Laidler with that optimism, Anastasia Amoroso with her optimism, etc. That's the Fed story today. The stock market likes what it sees.
If Savita goes to 4,600 from 4,300 over at Bank of America, I think we should talk about Max Kettner earlier on this week,
Yes.
Tom, just yesterday. Max saying people are too focused on what's going wrong. He wants to focus on what could go right next year relative to very downbeat expectations around China and around Europe.
And we just heard from Bruce Kasman some enthusiasm there about China. You know, he gave a typical J.P. Morgan, hedged it out. He's going to blame it on Ferroli if he's wrong. We understand that. But the bottom line is there's an enthusiasm here away from country to country domestic politics. We'll talk the UK politics on ESG here down the road. We don't need to do it now. But it's a ferment.
Sure.
It's a positive ferment here into these meetings.
If you aren't just joining us on Bloomberg Radio and you missed the conversation with Bruce Kasman over at JP Morgan, it's worth going back over. Bruce ultimately is on the high for longer page. How he referenced the dot plot and the projections over at the Federal Reserve, he used this word aspirational. He said it was aspirational, Tom, to look out next year to expect inflation to come in without too much damage to the labour market.
Yeah.
That's a man who does not believe that we can get inflation back to target down towards 2% without real pain in the labour market. Have we made progress on that so-called rebalancing in the labour market? Yes. Have we made sufficient progress? Bruce says no.
We've lost perspective of a fully employed America. The answer is we're at 4%. Bruce Kasman said he doesn't think we go above 4%. I have no wisdom on that other than to say that's the oddity of this cycle, and that's what the Fed has to deal with, is their dual mandate has become a single mandate. They're very ECB-ish.
Very ECB-ish.
They're ECB-ish, looking at rates, inflation. Oh, yeah, jobs, that's fine.
ECB last week, tomorrow the Bank of England, Friday the BOJ. Let's get to the price action. Your equity market on the S&P 500 shaping up as follows on the S&P. We are positive here by 0.2%. Yields are coming in just a little bit, down about 2 basis points on a 10-year, 4.3407. In foreign exchange, the euro 107.03, sterling weaker against the dollar 123.64. A soft inflation print out of the UK that we can discuss, Tom, a little bit later.
Yeah, I would do that a little bit later. But the answer to me, you know, as we dive into the brief here, John, is there's disinflationary tendencies out there. People are like, I don't really care about it. They're rationalizing disinflation, and it's in the air. Paul Krugman's essay in the New York Times, I think, really captured it.
Let's get to the morning brief for you. Coming up a little bit later, 2 p.m. Eastern Time.
We'll be here.
FOMC decision followed by Fed Chair Jay Powell giving that news conference. Plenty of questions, I'm sure, about the projections they'll release in the SCP a little bit later. 2 speeches to look out for. 2 speakers off Wall Street. The Bank of America CFO, Alistair Borthwick, speaks at 7:15 Eastern Time, so about 10 minutes from now, at the Bank of America Financial CEO Conference. And this one here, JP Morgan CEO Jamie Dimon speaks at the Detroit Economic Club at 1 p.m. Given the tension of this labour market, Tom, is in Detroit right now.
Secretary Dimon will be there. and we didn't talk about this in the last hour, but we're going to stop the show right now and talk about this. There are many people out there that wish that Mr. Diamond would migrate, as Mellon did, down to Washington to be bankerly. Can you do that in this time and this day
Treasury
and age?
Secretary?
Yeah, I don't know. But he's there in the crucible today of the American labor movement. It's extremely well done.
Shall we reflect on what UAW said yesterday?
We should. I don't know if they'll be at the lunch, but
Every
hey.
fibre of our union is being poured into fighting the billionaire class and an economy that enriches people like Donald Trump at the expense of workers.
I'm glad you brought that up. That was quite a statement.
It was a strong and powerful one, yeah.
And that sets up this tension of Wall Street, Main Street that Speaker Pelosi highlighted, many others as well. And I just don't think it's a small matter that a Fortress Diamond wanders into Detroit today to talk about the labor markets. What else do we have?
AMH joining us in about 10 minutes on part of that story. Just your earnings after the bell, a little bit later, after the market close. We'll get some earnings from FedEx. Look out for that a little bit later on. Joining us around the table here in London, the conversations continue. Patrick Armstrong, CIO of Plurimi Wealth. Patrick, good to see you.
Good to see you.
Are things good or just terrible? Because I can't decide based on our conversations so far.
Normal. Things are pretty normal.
No change.
Everything feels so different to how it was, but we've got inflation on a track down to something that's going to be sub 3% next year. I don't think it's going to fall to the Fed's mandate. I don't think they want it to. You've got economic growth that's a potential in the United States. Who would have thought that? You're probably going to grow 2% for the U.S. economy this year. That's probably the long-term potential. Interest rates at 5% on the 2-year. It's pretty normal. Doesn't seem normal over recent years, but we're in an environment where things are pretty normal.
We're going back to the old normal.
I think we are going back to the old normal. I think inflation is going to prove to be persistent, sticky, with intermittent spikes, just because the big picture issues are populism and protectionism from governments, and that's just by its nature inflationary. You've got unions coming back like the 70s, maybe a little bit. You've got job seekers having some power. That's inflationary. But you've got disinflationary forces coming from China, and you've got Fed policy at a point where it is restrictive. So all of those things, normal.
Your charm is your truly cross-asset. At the margin, how are you changing your cross-asset allocation into the fourth quarter?
So what we've done over the summer months is we've marginally reduced our equities that have just kept drifting to overweight. We wanted to have neutral weight, but just as equities have performed so well, they kept moving overweight. We've moved marginally underweight now. Not so much that we're worried about equities, that we're getting pretty compelling returns on tips right now, that you're getting a 2% real yield. And like I said, inflations are still a risk in the long term, but I'm getting the duration there. If we do fall into a recession, we'll see lower yields on conventionals, and tips will benefit from that.
So talk to our audience on radio and television here, and particularly across America. How does Patrick Armstrong utilize the 10-year inflation-adjusted yield or the 5-year inflation-adjusted yield? How do you use that as a tool to have confidence in market allocation?
Well, the 10-year break-even is 2.3%, and my view is we're going to have persistent above Fed target inflation. So I want to be hedged against that. I'm happy to get a real yield of 2%. You put your capital at risk to preserve capital as a starting point and grow the purchasing power of that over time. The tip provides that to you right now on the 10-year. So I like duration there. But you're being compensated with really high yields on, we talked about Diamond.
Yeah.
JP Morgan bonds, I'm getting 6% on a 2-year, and that's almost a risk.
That's a Chris Whalen moment. Yeah. He's channeling Chris Whalen, those JP Morgan preferreds, Whalen would say.
Should we do single names? A lot of people at the start of the year were getting jacked up on LVMH portfolios.
I was one of them.
You were too. You backed away.
Yeah.
You stepped away. The poster child of the European market now is Novo Nordisk. Where are you on that?
That's my biggest stock right now. And again, it's come from drifting. The pandemic used to be COVID. The pandemic's obesity and diabetes in the West. And Novo Nordisk and Eli Lilly, they don't have monopoly positions, but they got the dominant share here, growing earnings.
If luxury come in enough off China gloom, Bernstein, I believe, was out with a note overnight saying we've got some ratios of luxury back to 2008. Is it pulled back enough for Patrick Armstrong?
No, almost. So I sold LVMH in March. It was at 32 times forecast earnings. We're now in the mid-20s. I bought it in October the previous year when it was at 21 times. That's a small premium to the market multiple. That's where I'd like to buy it. So I think it's fair.
Folks, right there, we don't do much equity chat because, you know, who cares? The answer is what you just heard there from Patrick Armstrong is a clinic on how you bracket a beloved dominant stock.
I was with you. We were talking about it when you backed out of LVMH. You kept Hermes, though.
We did, yes.
Why was that?
Well, I didn't want to move against what I still think is the dominant trend is the spending power of high net worth individuals and also the immunity to input prices. Rishwan talked about inflation hurting spending power of people, but the input prices are things that are hurting mass market retailers, and it doesn't impact the high-end luxury.
So what's a distinctive feature of the Dumas family at Hermes? What are they doing differently? Bloomberg Intelligence, Deborah Aitken is just brilliant on this, and she singles out a few of these names. What is the Hermes model that makes them different from 47 other luxury brands?
The leather goods part of it is incredible. The margins, the growth they get there, and people pay up for that. And there's just waiting lines of queues for that side of things. But it's the brand management, the Hermes scarves and ties, and the leather goods. It's all,
We touched on it briefly. Let's finish there. Novo Nordisk. We're already up 40% this year. The stock's been climbing for 5 consecutive years. Can you spend just a little bit of time, a couple of minutes, just outlining how big this opportunity actually is?
Well, it was a vanity-type drug, their weight loss. It is a vanity product, basically, that people in Europe, America, and China... They spent the money to look good, feel good, but what they found is that the heart disease and the benefits on that, it may become an insurable product as well. So that just expands the potential market where you're not just getting vanity uses, but health uses, which may be insurable as well. So heart and stroke disease, it does expand the market a lot because it's an expensive product that a lot of people can afford. It may move much more mass market because of that.
The run on this stock, Tom, has been phenomenal, absolutely phenomenal. I'm not sure where we are right now versus LVMH, but certainly at one point earlier this year it was bigger than LVMH, right?
I think it's bigger right now. They're basically the same market caps.
Can there be European exceptionalism without technology? The way we trumpet Apple and the other 18 states.
Well, Novo Nordisk, I think, is a form of US exceptionalism.
Yeah,
it's just the wrong kind of US exceptionalism, right?
Yeah.
It's buoyant, to say the least.
It's, exceptionalism is very clear in US in technology. Europe can compete in healthcare. It's shown no ability to.
Quickly, are you buying big oil? You buying big oil here with $100 a barrel?
Basically, there's going to be more oil consumed in the next 3 months. We've already had more oil consumed today.
Single best buy. Come on, Patrick Armstrong, single best buy, big oil.
EOG, I like, rather than the integrated exploration production.
Patrick, good to see you. Patrick Armstrong of Plurimi Wealth. If you are just tuning in, welcome to the program on the S&P 500 right now. We are positive. We're positive by 0.2%. Outside of the equity market and the bond market, yields are a little bit lower by a couple of basis points at 4.34. Lots to talk about in fixed income. We'll do that with Alberto Gallo of Andromeda Capital Management. That's going to take place a little bit later on this morning. TK, some amazing calls there from Patrick. Novo Nordisk, the European healthcare company at the epicenter of the US health epidemic right now.
Yeah, he's been so on. I mean, the thing about Patrick that's great is a cross-asset view that he takes all the time. And, you know, you mentioned this, I think, yesterday, the day before, John. Everybody's got to recalibrate where the Q4 outlook, September 30 ending Q3, is maybe as important as the year-end outlook this time around.
Well, I think this time around for the Federal Reserve, they're marking to market. Growth has just been so much better than we thought it would be. We already know that. The Fed's just got to update their forecast to take account for that, Tom, into year-end.
You know where I am in the parlor game. I just and thank you for bringing up the dots. Let's review this right now. We've heard this morning that the 23 dot has value. There's a 24 dot. Is there a Draghi 25 dot? Are they going to go out to?
So let's just sit on the dots. We've got a couple of seconds. So for 2023, the median dot is expected to still show one hike this year. Might come in. We'll see if it does. 2024 has some easing baked in. But it's what's behind the easing that I think is really important. Is it a collapsing growth that leads to these rate cut calls? Or is it just this idea that inflation comes in, the Fed's focused on real rates and wants to maintain that restrictiveness? They're two very different things, Tom.
I think looking out that far, post-pandemic, as I mentioned to Dr. Kasman, can you look out that far given post-COVID supply and demand dynamics? I don't think you can.
Up next on this program, we'll look out to Detroit, the tension between UAW and the Big Three, and get the latest from the UN General Assembly. Bloomberg's Anne-Marie, next from New York.
When it comes to China, I want to be clear and consistent. We seek to responsibly manage the competition between our countries. We are for de-risking, not decoupling with China. We will push back on aggression and intimidation and defend the rules of the road.
It's an interesting word that President Biden used addressing the United Nations General Assembly just yesterday. He said we are de-risking, not decoupling. Curious because the Treasury Secretary went to China, Tom, and used the word diversifying. So which one is it? What's the message they want to send to China? Do you want to say de-risking? Because de-risking to me sounds pretty loaded. Are you saying China's the risk?
I think the political football here is substantial, and I'm going to say it's policy made up as you go. I think they're literally making it up as you go based on what China's doing and what the dialogue is. Very importantly, the meeting, Emery Horton talked about the meeting in Malta. Yep. Malta's an island in the Mediterranean. I don't know if you knew that. And
I'm well aware.
They had a meeting there of worthies to get Biden and Xi together, and that would be important. I mean, that's what diplomacy's about.
If we can make that happen, maybe a little bit later on this year. If you are just joining us, welcome. Federal Reserve decision a little bit later on this afternoon. No change to rates expected. Big focus on the forecasts. Growth, inflation, the dot plot. That news conference won't be a snooze fest. A sleepy start to the week so far, though, in the equity market. Futures just a little bit positive here by about 0.2% on the S&P. Yields a little bit lower by 2 basis points on a 10-year. 434, Tom, 0.7.
It is a busy week in New York and the island of Manhattan. It is traffic status. Ferro had a tantrum and said, we're going to London during the UN so we can miss it all. Emery Horton doesn't have that advantage. She is in the heart of Manhattan with the United Nations meetings. A very important interview yesterday with the leadership of Poland, of course, so adjacent to what's going on in Ukraine. But this morning here in London, Anne-Marie, I think we've ignored, I've been wrong on this with the Fed Day and all, we've ignored Detroit and the UAW. Who does the president need to speak to today? When he gets up and dials 1-800-DETROIT, who does the president want to talk to on UAW strikes?
Well, the White House has been talking to everyone, right? They're going to be speaking to the UAW president, Sean Fain, but they're also talking to the executives of the big three auto workers. This has taken on more importance, this story, because Friday at 10 a.m., we will hear from Sean Fain. He's going to be holding a Facebook Live. And that's really this new date for the negotiations to look forward to try to strike a deal, or he's going to announce more walkouts at more plants. The administration is in a very difficult position at the moment. Not only is the former president going to be heading to Detroit the day of the Republican debate, so really stealing the show from everyone, but the administration said they would be sending Julie Su, the acting labor secretary, as well as Gene Sperling, a White House advisor, who's the individual who's the liaison between the White House as well as the UAW and the big three. And those two individuals have yet to show up to Detroit. And I was reading a political article yesterday, and Democratic strategist said Trump scooped us. And at this point, it's not even about sending that. Now they look like, are they going to be following Trump's tail by sending someone, a high-profile person? But the bigger issue, I think, is the fact that they said they were going to be sending Julie Su and Gene Sperling, and that has yet to happen.
Maybe it's a silliness and symbolism of the Detroit leaders age ago driving to Washington to do whatever they did. Maybe the president needs to get in his Corvette and head up to Detroit. With that said, there's percolation in news. There was a union settlement in Canada overnight. There's also the idea that there's a tangential knock-on effects of the strike where the automakers are shutting down other factories. Do those kind of tea leaves, do they have any impact on the debate?
I'm sure they do. I'm sure Sean Fain sees all of this. One, the extraction workers were able to get in Canada, but also the fact that this could be impacting the knock-on effect, the supply chain effect that this is going to have on these communities. So they're obviously going to be taking stock of all of this, but he wants to use this moment to extract as much leverage as he can from the big three auto companies, and the big three are saying they're still at the negotiating table.
Where's the leverage, John? 32-hour work week? Help me here.
Pay at the moment. It looks like they can get more out of them on that side.
That's it.
Stellantis has certainly come up. And Marie, just to expand on the political conversation, you get the sense from UAW that they are sick of politicians playing politics with their cause. This is what you heard with the UAW president yesterday. And I'll share this quote with our audience, and I'd love your take on it, AMH. Every fibre of our union is being poured into fighting the billionaire class and an economy that enriches people like Donald Trump at the expense of workers. Is the former president still trying to go to Detroit on September 27?
The reports are that he is going to go there, and I think there's two key things we need to look at through the political lens. One is the fact that Trump won Michigan in 2016 a state that the Republicans have been unable to flip since the late 1980s. And a lot of this, if you look at, was potentially some of these rank and file members, not the UAW leadership. They would not endorse him. They're not going to endorse him in this round either. But then Trump lost it in 2020. This, I don't need to tell you, is a must-win state for Democrats. That's the first thing. I would also bring up the point that a lot of union leaders remember what Trump said in 2015 when he was campaigning. Remember when a number of automakers were talking about building facilities in Mexico, especially Ford, putting billions of dollars in Mexico. Trump said, why would you do that? Just move to a better U.S. state where you don't have labor, where you don't have union leadership. Get cheap labor, and then those people will realize they've lost their jobs, and then you can go back to your old factories. Right. And this deeply annoyed the UAW leadership, who said, philosophically, what is the difference of this? We are not being respected as a middle class, a working class. And those memories, I would say, they are still front and center for a lot of these individuals when it comes to the former president.
Emery, I got a segue here to your important conversation today. And as the gentleman from Poland was speaking in Polish, for me it was lost in translation, except boy, was there a tension in that conversation. Describe the tension that Poland faces at this moment.
Well, listen, Andrzej Duda has really been lifted by Putin's invasion of Ukraine to this global statesman almost. Remember in the start of the war, everyone was going into Ukraine, they still are, through Poland. He was this conduit between Kyiv and Western leaders, and he had this very close relationship with President Zelensky. He still does, but there is a ton of friction right now in this relationship that is playing out in the media. And what President Duda said to me is that his only plea right now would say, please stop doing this in the media, really taking a swipe there at President Volodymyr Zelensky. And some of the big friction comes down to the fact that we're not seeing a lot of Ukrainian grain moving out of the Black Sea corridor, so it's going into Europe. And Poland is saying, and they refused some of these tariffs at first to make sure they can help the Ukrainian farmers, but now what he's saying is that our farmers are not making the money they need to be making because there's too much cheap Ukrainian grain here. Zelensky wants to take this to the WTO, so they're having this spat about Ukrainian grain. At the same time, there's also debate within the Polish government about the financial aid from the Polish government to Ukrainian refugees who are settling in Poland. Just like you're seeing here in America, people are saying we are dealing with high inflation, we are dealing with higher costs of living. You're hearing this kind of conversation around the globe, whether it's Germany, whether it's Poland, and that is why you're seeing a little bit of war fatigue.
Anne-Marie, this is a wartime president facing a unique situation that these other leaders do not face. I think we have to acknowledge that.
Yes.
He's been celebrated by the West for the way he's spoken about the needs of his own country. I was listening to Speaker McCarthy yesterday. Do you get the sense that a lot of people, perhaps in Washington, of a certain politics are becoming frustrated with Zelensky's approach in the media?
I think some of them think that the approach in the media is a bit combative. And we saw that on display yesterday with the Polish president. He said, wishes, stop playing this out in the media. We've been strong supporters of Ukraine. Speaker McCarthy said yesterday that he just has a lot of questions for President Zelensky about where the U.S. taxpayer dollars are going. And remember, the last time Zelensky was in Washington, he gave this joint address. This is just going to be a huddle between lawmakers.
AMH, thank you. The latest in New York. Fantastic work at the UN General Assembly. Fantastic collection of interviews over the last couple of days. The NATO Secretary General and the leader of Poland. Equities right now positive by 0.2%. Coming up shortly, the brilliant Deborah Cunningham of Federated Hermes. That's next. This is Bloomberg. Equities positive here by 0.2% on the S&P 500. On the Nasdaq, slightly elevated. Some outperformance on a Russell. The small caps doing better than a good, up by 0.4% on the Russell this morning. We calling that a surge, TK?
Surge.
Is that how sleepy things have been? 0.4%. It's a surge.
I'm like, when does small cap calm down and actually put it on? And the answer is, there's so much angst out there, small cap really can't get it going.
Jill Carey Hall of Bank of America has been good on this as well. I want to turn to the bond market briefly as well. 2-year, 10-year, 30-year. We've got a rally in the UK. 2-year yields in the UK down by more than 10 basis points. A soft inflation print. Hot inflation print in Canada yesterday, lighting a fuse under this bond market. Yields shooting higher. New cycle highs on a 10-year. We're back away from it. We're down about a basis point on a 10-year to 434.47. But Tom, looking at that, you'd have to say we really have started to internalise high for longer. When you see
I
2 year
strongly agree with
north
that.
of 5%.
We are beginning to internalize the yield structures of another time and place, think 2005, 2006, and many of the different measurements we look like. You draw a horizontal line, John, and it takes you back to 08, 07, dare I say even to before August of 2007. What I end up looking at every morning, folks, is the 10-year real yield, and it's sort of in between 1.96 maybe is where we are right now in USGGT10Y.
Oh, that's the ticker on the Bloomberg. Nice.
But the answer is that's what I'm going to look at as we go through the press conference today to see what the real yield does.
If you look at USGG2YR, which is the nominal yield.
Good.
Thank you. Thank you. That's just north of 5%. 430s on a 10-year, 440s on a 30-year.
People just drove off the road on Bloomberg Radio.
I mentioned that rally in the gilt market for the UK bond curve. Yields down almost across the curve, particularly at the front end. This move in sterling weaker off the back of that. The pound against the US dollar, 123.65. We're negative by 0.2%. Tom, just looking at the inflation data out of the UK. So the good news is that it's no longer the 7% we expected. The bad news is this number still comes in at 6.7% year over year. And core, Tom, is down from 6.4, great, but it's still 6.3. So there's still an inflation problem in the UK, and we're still talking up wage growth that's pushing 8% in the United Kingdom. So the pressure's still on this Bank of England. Goldman's dropped its call for rate hikes for tomorrow, and they think over at Goldman, based off what we're hearing from the London desk this morning, is that the Bank of England is done. This is the peak rate. They're going to stay there. Question I've got, Tom, if you're going to stay there, how long for? With CPI where it is, with wage growth where it is, how long have they got to stay at these levels for?
It's essentially it's a boom economy that everybody's been wrong on. There's been a lot of gloom out there, and it's its own idiosyncratic story here. And part of it, to me, dovetails off Brexit and the relationship with Europe. And, frankly, I think the United Kingdom needs a strong Europe, and it's not there right now.
It isn't at all, based on what we heard from President Lagarde at the ECB last week. Nothing strong about that news conference.
I read Phil Serafino's stuff
last
today.
week. Phil's great. 107.01 on the euro at the moment. That currency pair positive by 0.2%. Under surveillance this morning, the Fed rate decision due out 2 p.m. this afternoon. A pause is widely expected, but a bit more debate around what this Bank of England will do tomorrow after UK inflation unexpectedly fell. Goldman altering their call, writing this: with today's data, 2 out of the 3 indicators that the Monetary Policy Committee has set out to monitor inflation persistence have now shown notably more progress than anticipated since the August meeting. We now expect the MPC to keep rates unchanged. Once you've got through the Bank of England, Tom, it's on to the BOJ on Friday.
Catherine Mann's going to push against that. She is American, Brandeis University, of course, her wonderful work at Citigroup. She is on the MPC, the Bank of England. And I would suggest that Dr. Mann would say, let's watch the data. And to your point on change in vector versus level, to everyone in the United Kingdom, it's that level above 6% that's intolerable.
I'm with you. That split on the MPC, let's see what that split looks like.
Yeah, they never dissent. I mean, they dissent.
We get a dissent on Threadneedle. We
do.
don't get any dissent over at the
Fed is,
Federal Reserve.
It's a snooze fest.
Singing off the same hymn sheet, apparently. Oil dipping this morning after a soaring summer rally. Saw prices rise more than 20% over the past 3 months. Crude touching 10-month highs, approaching $100 a barrel in the last 24 hours on the back of supply cuts from OPEC+, but falling back below 94 ahead of this afternoon's Fed meeting. 93.75 after a sniff, Tom, of 95 on Brent.
I think, a bit of the story's missed here. This has to do, again, with oil in the Caspian Sea. This has to do with Azerbaijan. I'm not going to pretend I'm an expert on it, but it is the ageless battle of those Caspian states, Georgia, Nagorno-Karabakh, and the rest. Amory Horton's way better. Maria Tadeo's expert on this. But there was a little bit of war tone yesterday, which got us up to Saudi 97. It got us up to 95 on Brent crude. And there seems to be not peace in the air, but maybe the tensions pulled back off the Caspian Sea today.
Fantastic to catch up with Javier Blas of Bloomberg a little bit earlier today, who basically said it's all about price for Saudis now. And they've got a higher tolerance for economic stress abroad. They want prices near 100. Yeah. His opinion, maybe that resonates, but that's his view.
He walks in the building and the foundation shakes. I mean, you know, he's huge.
He's a heavyweight.
He's a heavyweight.
A heavyweight in the world of commodities. I want to finish on this, an update on UAW. United Auto Workers weighing in on expanding their strikes as negotiations with Detroit's automakers continue. The union is set to hold a Facebook Live event at 10 a.m. Friday, where it's expected they will discuss whether more plants will join the strike. So like we had last week, we have a deadline. It's noon Eastern on Friday, TK, for further progress. If we don't have that sign of progress, ultimately 2 hours before that, we're going to get some kind of Facebook Live event, some kind of news conference from UAW, which may signal a broadening, a deepening of these strikes.
Walter Reuther wouldn't have done it this way. I mean, it's not your father or your grandfather's strike of union members. Are these companies the same companies and acting in the same process as they did in 1958 or the tensions of the 70s? I don't think we know yet.
So you can answer that question. I'll answer this one. UAW certainly changed their approach based on the assessment I've seen.
Absolutely.
This isn't targeting one. This is targeting all three simultaneously at the same time.
And they know, they're sophisticated enough to know the knock-on effect. One of the makers came out and said, you know, if you're going to take out my Bronco factory or you're going to take out Michigan Truck, well, then you got to go out and there's this knock-on effect of 14 other factories, and literally in the next 48 hours.
And tons of other companies down the supply chain.
Yeah.
Tom, who are going to be hit by this as well. It's not just Detroit's big three, that's for sure. It's
continue to follow that
companies.
Great team in Detroit leading that coverage, and we'll catch up with them through the day, this Fed day, I should say. Right now, this is an important conversation, and please lean forward as you figure out what to do with your short-term money. Deborah Cunningham, a fancy title, Global Liquidity Market CIO. At Federated, essentially they invented the money market fund, and with Federated Hermes, she joins us this morning. Deborah, what do you see in money market fund flows? What are we doing as we migrate from banks to a higher yield money market funds?
Well, certainly we've seen it in, full force over the course of the last 6 months. And it's really, it began back in March of 2022 when the Fed increased rates for the first time. You've basically got in its, sort of most inclusive form, money market funds with assets greater than $6 trillion now. So, if you kind of go back to the, days post-Lehman, this is 3 to 4 times what the market was at that point, and certainly what it was in the zero interest rate environment. So at 5+%, money market funds, especially for the retail investor, offer great returns at this point.
Deborah, I look at the Keefe, Bruyette and Woods Bank Index, the so-called BKX, and it's sobering to say the least. What is a Federated belief? And I know you're doing rates, it's maybe outside your remit, but how do you look through the Cunningham prism at what our beleaguered regional banks are doing?
Tom, we do a lot of business with the banking sector from an investment perspective as well as from a counterpart standpoint. So we're always looking at the health of banks and, what their activity in the market might be looking like. And at this point, the largest and what I'll call regional and kind of super regional banks seem to be quite healthy. Even, in the context of the commercial real estate portfolio, there seems to be, a pretty good mix of what I would call the better types of commercial real estate within those larger banks. Now, some of the much more, much smaller, very concentrated regionally and geographically smaller banks, that profile is not the same. So I think what you might end up seeing through this next cycle from a banking perspective is a little bit more consolidation of some of those smaller banks into some of those larger, sort of regionals and super regionals in order to keep the market in overall, in an overall healthy sense through, what might be the next downturn from an economic standpoint.
Deborah, we'd love your view on the Federal Reserve a little bit later this afternoon. Andrew Honhorst, a Citi just published moments ago. He had this to say: the Fed will skip hiking rates at 2 p.m., but dots will likely signal one further 25 basis point hike in 23. The median dot for 2024, they think over at Citi is at risk of rising 25 basis points. It's all incremental stuff, Deborah. For you and the team, when you get those projections a little bit later, what are you and the team looking for?
I think definitely a skip, not a pause. And I do think, they're going to emphasize that November continues to be a live meeting. I would not be surprised to see the economic projections and the medium dot to go up by 25 basis points more. Ultimately, although inflation, is lower than it was 3 months ago when these numbers came out, it's still firm. And in the most recent information, CPI, PPI, PCE, retail sales, they're showing the consumer being very strong and some of those numbers playing through to mild increases in those numbers. So we would not be surprised. I agree with you that, the market maybe is finally reconciling with higher for longer, but I'm not sure we've priced in what we think is a real live meeting in November at this point.
Holland Horse cites three things, Deborah: oil prices, ongoing UAW strike, third thing, renewed advance in house prices. How do you think the chairman navigates those three issues?
I think all of them have to be addressed. I mean, they impact the consumer. And granted, the consumer has, from a wage inflation standpoint, also been improving from, a household net worth standpoint. But they're paying higher energy costs, they're paying higher food costs, they're paying higher shelter costs, and all of that comes out of their discretionary spending. So I think as the engine of growth to keep this economy, sort of above water, there's a little bit of a pullback on that from a consumer standpoint at this time. So, the chairman can't ignore that, but by the same token, are they going to be able to, marginalize and not raise interest rates by another 25 basis points? I think it's going to be a tough decision, but one that will, make the November meeting a little bit more, sort of in the limelight and focus for interest rates in the next several months.
Your view, you're not alone. Mike Gapen, Bank of America, Andrew Hollenhorst, the City, on the same page. Deborah, thank you. Deborah Cunningham there, Federated Hermes, the Federated Hermes view on the Federal Reserve. If you are just tuning in, welcome to the programme. The S&P 500 right now is just about positive by 0.25%. Outside of that, into the bond market, yields are a little bit lower by a single basis point at 434.47. I mentioned that research from Andrew Hollenhorst, the chief US economist over at Citi, who had this to say: Chair Powell acknowledged recently softer inflation and lower job openings, but emphasise vigilance, he says, given remaining upside risk to inflation on those three issues that I mentioned, including the rise in oil prices, ongoing UAW strike, third one, renewed advance in house prices. Tom, of those three, what are you focused on? Strike, commodities, house prices?
I'm not focused on the political story. I don't think the Fed really does a mandate off of that. Maybe Greenspan would have a million years ago. I don't see it with Powell. I do see it with the house prices. I think they'll watch it very carefully. And to Paul Krugman's idea of plain vanilla inflation and rents are shocking, yeah, I guess they're down in the West. But the answer to me is you got to get from the soup, the alphabet soup of inflation indicators Deborah Cunningham just brought up, to what our viewers and listeners are feeling. Powell viscerally knows that, and he can't go accommodative until he's got more of a vector in place. It's not in place yet.
So acknowledge progress without signalling victory.
Yeah, exactly.
Ultimately,
he's not going to declare victory as Governor Bailey.
I don't think Governor Bailey can declare victory.
No, but he alluded to it a couple of meetings ago. And none of these people are anywhere near this. It goes back to what Wells Fargo said about the last mile. We're not in the last mile. We're like on the last time zone. We're not there yet.
Sarah House was right. That last mile is going to be tough. Coming up next, a treat here in London. Kathy Wood of ARK Invest. That conversation coming up shortly. Live from the City. This is Bloomberg.
I think tech still has a bit of room to go in the next couple of weeks. There is probably a window around Q4 where I'd be moving more towards really the value side of things, right? Tactically, right? If we get that bump in inflation, particularly in the US a bit higher, you want to probably prefer then for a couple of months things like banks or energy over tech. But for now, I think energy still has, or tech still has a way to go.
Based on what we heard from Max Kettner, the chief multi-asset strategist over at HSBC, it feels like Goldilocks forever for Max. At least Goldilocks for now. Constructive on risk assets. If you're just tuning in, welcome. Equity's doing okay. Positive this morning by 0.2% on the S&P 500. Going into this Fed decision, cycle highs on a 10-year yield in the last 24 hours. Backing away from that just a little bit, down a basis point on a 10-year, Tom. 434.67 on a 2-year, still dancing in and around 5%.
I'm going to look at the real yield. The oil pullback, oil's been front and center this week, but into these 3 meetings, I've got to look at inflation-adjusted yields. Patrick Armstrong, I think, was very articulate about that. That's where he is. That's where he's finding protection. But to see what the real yield does off the chit-chat today, and I agree with what we've heard on to November and, frankly, a focus to December as well with the Fed.
The risk of one more hike. Andrew Hollenhorst, Citi, Mike Gapen, BofA, Deborah Cunningham there. Same thing.
Yeah, there's a lot of cross currents here. We'll have this for you this afternoon. Remind me what we're doing, John. We're at 1:30. We're starting
Eastern time, so 6:30 London time. We'll start the Fed special.
In the middle of
get the decision
hour.
30 minutes
I like
later.
This. That's good.
And then we'll beat the drum into the news conference 30 minutes after that.
Into the news conference as well. And we'll be with you tomorrow, of course, for Bank of England. And who's on Friday?
BOJ.
BOJ. And that'll be interesting for Mr. Ueda as well. We welcome all of you worldwide on Bloomberg Radio and Bloomberg Television to a conversation of great anticipation. Cathie Wood came out of USC a long time ago, put out a shingle with a Lovelace family at Capital Group, and then built an investment career quite different from others, not so much based on the long-term solidity of a given portfolio, but capturing the trend, going up large, and sometimes going down large. She holds court on the Ark. Noah's Ark is where she is right now. I want to know, with all you've been through the last number of years, are you going to shift to a more long-term strategy? I look at Morningstar, 1 year, 3 year, 5 year, your bottom quartile, but your claim is more short-term. With your new ETF effort and with what you're doing with Ark, are you going to be still on trend, or do you invest more for long-term?
We've always invested for the long term. And what interrupted what was a very nice move up in innovation stocks, especially disruptive innovation, was a massive increase in interest rates, the likes of which we have never seen.
Of course.
24-fold increase. So all long duration assets, especially in 2022, were destroyed, including bonds, which are usually a flight to safety. They had their worst year last year. Since the 1700s. There's no way in that environment that our strategy would have done well. But I do think that what's happening this year is that the market is starting to look over the Fed's moves, whether there's one more or not, into falling interest rates. You know, we started underperforming in 21 just with the anticipation of rising rates, and even more so in 22.
So how are you going to change? I want to know how you're going to change the sobering quarters you've been through. What is the new Cathie Wood approach to macroeconomics, frankly, pandemic economics, intruding on your belief in innovation?
If anything, innovation gains traction during tough times. And if you look at how the reason our portfolios are outperforming this year is... And they are, it is because they are gaining share in what is becoming a difficult environment, right? And so one by one, we're going to earn our way back, and it's all about revenue growth, margin expansion.
In the Wall Street Journal, they do a fabulous thing with old farts like me, and it's people with over $5 million, and they believed in Cathie Wood. To a person, those retirees bought innovation, they bought tech, they bought Apple, and they didn't listen to financial TV or radio. Can you do the Cathie Wood approach for 1, 3, 5 years, given the volatility you've seen?
Yes, I think we're on the other side of that massive interest rate increase, which did destroy a lot of performance. That's the most important thing. And we are ready for prime time. Many people are concerned about our kind of strategy. And the company we just acquired, Rises, because in Europe, in London here, for all of Europe and UK, they're focused on global megatrends as well. And, you know, interest rates hurt everyone in that space. If we are right and rates are going to come down at some point in the next year, you know, the market is a discounting mechanism, then I think that the muscle memory that hurt our strategy, and it all has everything to do with the tech and telecom bust, and people thinking, oh my gosh, are we here again? No. What happened during the 20 years that ended in the tech and telecom bubble is the seeds for what is happening now were planted.
Yeah. And this, John, is really important, and that the profitability stream down the income statement of new tech is very different than 2000 tech.
Let's talk about EVs.
Yes.
And not just Tesla.
Yes.
Is it good news for Tesla what's happening in Detroit right now?
Yes, because if there's a strike, of course, there will be more production shortfalls. You know, I think that there's just now the supply chain has freed up, so unfortunately we'll have all kinds of questions about that. But you know, I don't think it has anything really to do with the strike. It has everything to do with a consumer preference shift towards better vehicles, electric, that are falling in price. Tesla's leading that price decline simply by passing cost declines on to its customers. So I think that's what's good for Tesla.
The complaint we hear is that people can't afford these vehicles. What we're seeing in the news
changing.
in the UK, as you can see, Rishi Sunak is pushing back targets to get rid of all of these internal combustion engines to 2035 from 2030. Are we being unrealistic about this transition and how difficult this is going to be?
No, we do not think so. We actually, the total cost of ownership, now this is in the United States, it's a little bit different here, but the total cost of ownership of an electric vehicle fell below that of a gas-powered vehicle about 2 to 3 years ago. Soon, sticker prices.
Does that include insurance?
Yes, includes insurance. Yes, as I said, local differences, but yes, in the United States, that does include insurance. And in fact, Tesla is so sure that its cars will have fewer accidents and fewer fatalities that it's willing to provide insurance. So yes, that does include everything, all in.
You were at USC, you didn't get a B. Laffer called up Robert Kirby at Capital Group and said, just shut up and hire her. So you walk into Capital Group, which is the land of an R-squared and 98 Washington Mutual Fund Investment Company of America. Yes. Everything is completely diversified out. You're the polar extreme. They threw you out. You almost fell into the Pacific Ocean. They were so upset with you. So you go out and you say, I'm not going tight R-squared to SPX. I'm going out and do my own thing.
Yes.
People have prospered off of innovation and technology. How does that continue in America? Can you be less diversified and win 5 years out?
Well, you mentioned Capital Group, and that is where I did start my career. And that is where I saw tremendous research and a long-term time horizon. So really what we're doing with ARC is just going back to the future. My initial experience, which was in the late 70s when I was in college, and we're doing deep research, first principles based, white sheet of paper.
But you're away from an R-squared like Washington Mutual or the other funds. What's your R-squared right now?
To be honest, the correlation of our performance to broad-based benchmarks is very low. For better or worse, what it tells our clients and prospective clients is we have a very good diversification strategy. Our funds, the active weight, if you're comparing to MSCI World or S&P or NASDAQ, the active weight is less than 5%. So really good diversification strategy focused on companies that are going to transform the way the world works. We look at the broad-based benchmarks, and sure, there are companies that are sustaining innovation like an Apple, but they are not going to transform the way the world works from here. Our companies are.
Kathy, thank you. Kathy Wood of ARK Invest. I can't believe it's been 3 years. It was right before the pandemic and New York shut down.
Well, she ignores us. We've tried to get her out.
Been that long. You've been ignoring us, Kathy.
No.
That's what this is about. Come on.
We should mention she's got a new ETF in Europe. They're bringing it into the ARC model as well.
And we should talk about growth stocks.
The European probably Novo, what's it called? Novo
growth stocks
obesity?
in Europe.
Yeah,
Novo obesity, is that what it's called now?
Yeah.
Over at Novo Nordisk.
Yeah.
Alberto Gallo coming up next. Futures positive here on the S&P. This is Bloomberg.
if you get yields moving higher, that's probably in response to growth doing better.
I worry more about a yield-induced issue somewhere.
I think a lot of our economic models just aren't working now. The pandemic's just thrown them into disarray.
I did raise my outlook for a recession risk from 15% to 25%.
We can't have Goldilocks forever. We are going to start to see biting within the growth standpoint.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio and television across America, worldwide, from our studios in London. Lisa on assignment here. It's going to be an interesting hour. We start strong here for Global Wall Street. We'll go to bonds here in a moment with Alberto Gallo. But, John, we've got to focus on this Fed meeting coming up, cocktail hour in London. It's a different Fed meeting.
It's a different Fed meeting for us. It's a different Fed meeting for others as well. We do get forecast today. Unchanged is the call, but it's the forecast we want to have the discussion about with Kathy Jones at Charles Schwab, Matt Lazzetti at Deutsche Bank, Dan Swank at KPMG, and Andrew Holdenhorst at Citi. How do these forecasts change? They're going to have to market growth. Growth has been better. Growth is going to be evaluated higher, we expect, Tom. Inflation may be a little bit lower. That's 23. What about the dot plot for 3 and 24? That's going to be the call here. Where do they see interest rates going into year end? Maybe one more hike. Let's see if they back away from that. Where do they see interest rates going into next year?
That's the Mike McKee guy idea, the parlor game of it, as you will. What I like there is we're going to get from Diane Swank the effect of the UAW strike is one of the worries that are out there. Andrew Hollenhorst lines them up like ducks this morning. His Citibank worries where you stay up at a higher rate. Matt Lazzetti modeling out a slower economic growth. And there's different narratives here that Chairman Powell has to calm. I look for a calming voice
It's
today.
a timely news conference, Tom. Those three issues that Citi talked about, crude in the 90s, UAW strike ongoing, house prices recovering. Do they have the inflation data behind them, the incoming information to say we've made progress? Absolutely. Can they declare victory in a meeting like today? No, they cannot. Which is going to be the story, likely, in the news conference.
In the heart of it, and one of our great themes here, particularly going to Bank of England tomorrow, is this phrase, anchored. Are central banks anchored? Do they have control of the moment now or the moment out 3 years, 5 years? And in England, it's a different challenge. The level of inflation, folks, over here is totally different than in the United States.
Has it improved? Is it lower in the UK? Yes. Is 6 a problem? Absolutely. It's a problem for the Bank of England. I'll give you two names, Tom. Alsa Linos of RBC. She sat just over there.
Yeah.
Simon French of Panmure Gordon in Alsa's seat a day earlier. Both said the same thing. They think the communication of the Bank of England hasn't been good enough. It's been insufficient, and they face a credibility problem. Now the call from Goldman is no hike at all from the Bank of England tomorrow morning.
I was surprised
Goldman
by that.
thinks
Full
they're
disclosure.
done after that inflation report this morning. So big rally in the UK gilt market, and sterling a bit weaker off the back of that data earlier on.
And let's get to the data, but I really want to say that the communication will be improved at the Bank of England if John Ferro could be in the press conference here that they have to talk to Governor Bailey. They don't do them every time, do they?
Not every time.
That's the first mistake.
No, you get them when you get the forecast.
In the modern world.
You'd like a regular meeting and news conference from Governor Bailey?
Not really. You know me on communication as well. Let me communicate to you the data check. Oil pulls back a little bit. Yes, Azerbaijan and all near the Caspian Sea calms down, and it surged to 95. John, back a couple dollars, but 90 is a difficult number for Jerome Powell.
Equity session highs. We're looking pretty decent here, up 0.24%.
Dow Jones Industrial Average
on the S&P. I say we're looking pretty decent. I'm leaning on the call there of Savita Subramaniam, who's saying 4,600 on the S&P. That's an upgrade from 43. It's amazing to see these upgrades, Tom, just keep coming through when people are talking about the potential for weakness.
It's that time of
in the
year,
back
but
end of the year.
I want to make a point that when you have BNP Paribas upgrade in a jump condition to a new level from being very cautious, that's a different upgrade than the marginal upgrade we got from Savita.
True. Savita's still looking for upside, and Greg Bowdle at BNP is not.
Yeah. You know, I think that they can be different and nuanced. We're going to be different and nuanced here as we look at equities, bonds, currencies, commodities, at the dynamics of full faith in credit and the credit market. Expert on this across all geographies, but particularly Europe, is Alberto Gallo. He's with Andromeda Capital Management and joins us today on the tea leaves, John, to see from credit in your Europe.
The CIO and co-founder. Alberto, good to see you.
Thank you.
Why have I not heard the word stagflation more than 2-3 times this week? I thought I'd hear it every 10 minutes?
Well, you're in London and the UK is in stagflation, right? That's the wage dynamics. There's an entrenchment in inflation where you see, 8, 10, even 14% wage rises on an ongoing basis. And many of these negotiations embed a forward-looking raise, a forward-looking increase. So they're not just increasing one-off, but they're going to keep increasing. So the dynamics have changed. As a central bank, you should only say that inflation is transitory, if inflation has gone back to target. But calling it transitory ahead of time is obviously a credibility issue. And that's what the Bank of England is dealing with today. Unfortunately, they can't raise rates too much because of the over-levered situation in the property market and the household sector. So it's a lose-lose situation. The growth inflation mix is much worse. And against this, we have a consensus in the market which is very relaxed, with very low volatility, very high equity valuations. Why? At the beginning of the year, everyone was very, very bearish, very positioned for recession. But today, most investors, according to market surveys, are positioned for soft landing. So we've gone from one side of the boat to the other, and we have to deal with with a worse growth inflation mix going forward, both in the UK and the Eurozone.
And Europe, but not the US.
The US went to the party, Europe got the hangover. So the differential in growth between the US and Europe is widening even more. We're seeing it in FX, but the US is not at recession risk. The US here is at reflation risk. Oil is a positive for the US, and inflation is going to be around 3%, but the economy can live with 5%. In fact, there's too many cuts priced in for the US next year.
Alberto, how do I invest in that world? Stagflation reality that you just outlined, and inflation reacceleration risk on the other side of the Atlantic. What am I meant to do?
So look, for sure, what you don't want to do is have a long only, buy everything. What worked with QE, that kind of strategy is not going to work going forward, because there's going to be more volatility, there's going to be more relative value. So you have to be more tactical. Now, today, in an economy which has high inflation and a Fed that's priced for cuts, but it's not going to cut, which is what we think about the US, you don't really want to hold bonds. So we still see a potential for higher yields in the US, in the middle of the curve, in the long end. The BOJ is the elephant in the room for the world, of course. If they exit from zero rates, that creates pressures. In Europe, though, people worry about European recession, European high inflation. Europe, in the end, always grows between -1% and +1%. And, we are seeing a very muted situation. The 4% hike by the ECB is probably going to look like a policy mistake. So, and here, there's a premium. So we like being in Europe in bonds very selectively. And in the US, we think bond yields will keep going higher and spreads as well, because there's too many cuts priced for next year.
I would suggest that's an outlier view. And if I look at the Bloomberg Total Return Index, the US aggregate index, very few people are really looking at price down. Are you suggesting that price down, yield up can breach the lows of price that we saw, I'm going to say, 18 months ago?
We can go wider. I mean, we talked about it. I think long bonds, long duration was probably the most popular view in Q1. A lot of pitching.
Yeah.
And long U.S. investment grade up in quality has been super popular. But in the end, you're not.
But I don't mean to interrupt, but this is absolutely crucial, Alberto, as you take a real minority view here. If I get price down, yield up, no one's looking for that. What will be the market ramifications of a new regime within higher yields across credit and full faith in credit?
What everyone is hoping for is yields will go back down and companies will be able to refinance. But if yields if interest rates stay at 5...
What's the stock market do?
The stock market is a little different from the economy, you see, because large companies have termed out their maturities. But if you're looking at the high yield market, which is smaller caps, then you need to see wider spreads. You need to see a rise in default rates. But yeah, of course, the stock market is complacent.
You've told us a lot about what you don't like. What do you like? I'm assuming you're not just sitting there in cash.
No, we like some areas of European markets and some U.S. areas of U.S. markets too. So we like Ukraine. We think that there is an improvement there. Slow but steady. They're doing the right thing, the right strategy. They're not throwing all the weapons and the resources at once. They're advancing slowly. And it's an opportunity that's been unloved by the market because of the binary risk of the war. We like some countries that are going back into the investable universe, like Greece, which has an investment grade upgrade ahead. And we like some defensive sectors, which in Europe are pretty, well capitalized compared to the US.
I thought I'd misheard you, but I'd like you to repeat it. You like Ukraine.
We like Ukraine. It was
what does investing in Ukraine look like?
Well, it looks like buying bonds that are essentially left for a very low recovery value. They were at 20 cents on the dollar at the beginning of the year, now they're at 30 cents on the dollar. And GDP in Ukraine is not far off from where it was pre-war because of all the support that foreign countries are giving to Ukraine. So,
how do you buy a bill, note, or bond in Ukraine? Do you have to be somebody fancy like you?
No.
Or can one of our listeners and viewers purchase Ukraine this morning?
It is a distressed trade, but it's a dollar security. So it's a New York law security. So like many other emerging market countries, which are restructuring, but the difference is that investors have not
I got to ask a Abramo question. She's on assignment this morning. Help me here. On high yield spreads, how many basis points do they widen out looking at a vanilla index of high yield spreads? I'm speaking as a hack.
Yeah, we're around 400 bips now in high yield. That's where we were in January, February. Yeah. But the difference is yields on the Treasury are pushing much wider. And spreads have not moved. There is a point where, if rates and yields, long-term yields go wider, at some point something can break in the high yield market as companies need to refinance. And so we're looking for a little bit wider. We're looking for 450 or 500 to go back to a mean.
100 bips. Did I do okay there?
That was
I was trying to channel Bramo.
That Bramo would be proud. Thank you. Alberto, this was great. I always butcher your name. Not the name of yours, but the name of the firm. Andromeda. Yeah. Capital. I've got this. Right. Andromeda Capital Management.
They're in the aluminium business.
Alberto, go. Are you starting? Yeah. They're in the aluminium business.
Aluminium business.
I like that. There you go. There you go. Nice.
I was at the Dorchester with a cocktail. I was at a miners thing last night at the Dorchester with an umbrella in the drink.
The LME.
And they were talking about aluminium.
Guys.
Yeah, cool. Aluminium.
If you're just tuning in, welcome to the program. TK adopting some English words for metals.
Yes, thank you.
Equity futures on the S&P 500 just about positive by 0.2%. Yields higher, then lower. We're down a basis point this morning, 434.47 on a US 10-year. Alberto, we hardly talked about Chairman Powell later on this afternoon. What's the guide here? Go to the pub, get some drinks, or actually watch this news conference this evening?
I think that his challenge will be to push back the expectations of cuts that are built into 2024 Fed futures. We've got over 100 bips of cuts. We've got oil towards $100. It's not a bad thing for the US. We're seeing, according to our models, around 3% headline inflation at the end of 24 in the US. So that's above target, but it could be 30, 40 bips higher if oil goes up another $10 from where we're now. So there's a risk that 3% goes to 3.5%.
So pub this evening, right? That's what it sounded like. Alberto, thank you. Jonathan Pingle of UBS is coming up a little bit later. TK is going to be in the pub straight after that news conference begins. We'll run you through and keep beating the drum to that Federal Reserve decision later on this afternoon. 2 p.m. Eastern Time, expecting no change, but plenty of action when Mike McKee has to open up the summary of economic projections and get the outlook for growth, for inflation, and for interest rates as well. That so-called dot plot for 23, 24, and perhaps a little beyond too. Coming up shortly, Henrietta Trace of Vader Partners on the looming government shutdown. The shutdown that we just don't really want to talk about, but we've got to talk about because it's real. We're doing that again.
It's real.
I mean,
yeah, it's real.
Really? Okay, we're doing that next. From London, this is Bloomberg.
I don't think anybody wins a shutdown. Think for one moment what a shutdown does. Stops paying our troops. How do you have more leverage in that situation? I've watched shutdown after shutdown. Everybody loses. It's not a continuing resolution in the essence of what you've known Washington to be continuing resolution. This actually cuts wasteful spending. This secures the border. In the past, the continuing resolution was just continuing spending the money.
House Speaker Kevin McCarthy addressing criticisms of a short-term plan to prevent a US government shutdown. It's that conversation all over again. Let's turn to the bond market briefly. 10-year this morning, going into that Fed decision a little bit later this afternoon. 434, yields down a couple of basis points. 2-year, 10-year cycle high in the last 24 hours. The 2-year on a closing basis point yesterday, on a closing basis, 5.0 9% in yesterday's session, Tom. The 2-year backing away from those levels to about 5.07. But on a closing basis, we're talking about cycle highs at the front end.
Yeah.
And on the 10-year, it's pretty remarkable stuff going into this Fed decision.
I thought it was underplayed yesterday, John. I think you're absolutely on here. We've really seen some movement here in yields. And, yeah, we give it away here. West Texas Intermediate, 90.44. I really want to emphasize, folks, still we're in London. Our team is fully focused on the Fed, and we'll be giving you our usual coverage this afternoon. Thrilled to do that from London here. Look for that. Matt Lozzetti, among others, Diane Swank joining us as well. You know, I think, John, and I really want to explain this through a London prism here. What we're seeing is malleable politicians. And in London, we are seeing the Prime Minister of the United Kingdom flat out capitulate in the last 24 hours on the green movement in the United Kingdom, John. It's on the top of every newspaper here.
Some people might say it's being realistic to push back some of these targets
to get re-elected.
2030 to 2035. Perhaps that's part of the equation. I imagine it is, to basically convey some differences between him and the other party sitting across from him. But realistic in the sense that this transition is going to be much, much harder than we make it out to be. That shifting away towards electric vehicles is not going to be that simple, and for many people will be increasingly expensive. Kathy Wood of ARK Invest sat around the table with us in the last 30 minutes and suggested prices can come down a whole lot more, led by the likes of Tesla. But let's have a look at what's happening with UAW right now and Detroit's Big Three. Do they look like companies that are going to be in a position to drive costs down, given where labour costs might be over the next 4 years and beyond?
And the business realities away from the wage discussion at the UAW. To bring it to America, once again, no, we're not looking at ESG in America. We're looking at government shutdown. We've ignored the story. We're going to dive into it right now with truly an expert, Henrietta Trey's Economics Policy Research Director, at Veda Partners. Henrietta, Washington Post, House flounders. How floundering is our political system right now in America?
They're on the ocean floor, just chilling with the flounders, for sure. It's been a train wreck for 9 months now, and it just will continue to be that way. The one thing I would say to investors watching this is be mindful of the calendar. It's Wednesday. We have 10 days before the government actually shuts down, and it's worth getting specific. That happens on a Saturday. No federal employees actually stop going to work until Monday. So we really have like 12 days to resolve this. That's a lifetime in D.C. I hate to nitpick, but it really is the most effective way to watch Washington, D.C. Right?
Henriette, I had a period where I realized I didn't know much about American politics of the 1890s, and this really harkens back to the vast polarization pre-Teddy Roosevelt, the time of Grover Cleveland Alexander and the rest. And what I want to know, Henrietta, is with the election coming up, do we get clarity here, or do you suggest more floundering past November of 2024?
I think we're going to flounder until 2024 November because we're going to be dealing with the exact same margins in the House and Senate for the rest of the period before the next election, all the way through January 3rd, 2025. And that is something to really bake in here. So if you don't believe that there's a shutdown happening in September, which is my base case scenario, you know, you really are going to have to adapt to the fact that we're going to be in the same exact boat in December, probably again in April when the sequester cuts might actually go into effect, and then through the summer of next year as we head into the elections. And I think that there are about 5 House Republicans who would happily shut down the government for that entire period of time if they thought it would get them more campaign fundraising and attention.
Henrietta, I got an audience question just seconds ago. I'd like to share it with you, and perhaps you can help us answer it. We say things like government shutdown. They want to know how much of the government actually shuts down.
Great question. It's about 850,000 federal employees. The average salary is about $73,000. The Bureau of Economic Analysis, the Department of Labor will not be able to publish their data. That is hugely disruptive for people watching that on the street, for projects that are not funded independently. So just to be crystal here, the Federal Reserve is funded independently, so they won't have to worry about any of this. But any federal agency that operates via the discretion of Congress, which the majority of them, will see their expire.
Henrietta, Anchor emails in and says, do they shut down customs? Can John and I get back into the country?
you will be able to get back into the country if the FAA employees decide to work without pay. Last time around in 2018, LaGuardia shut down and had a stop flight order because you're asking these FAA folks who are, waving those pistons to say, hey, come in and work for free, because they're not getting paid. They are essential workers, but they will not be getting paid.
Right.
The risk is real.
The Speaker McCarthy, is he working for free? What's his shelf life right now? Give us the Trey's analysis of how the Speaker battles through this.
I'm going to keep it real with you. I do not think the House Freedom Caucus has the votes to oust Speaker McCarthy. I spent all day yesterday speaking with former and current Democratic staff. The motion to vacate a chair is the exact opposite of the hurdle for Speaker McCarthy that we saw in January. The burden is on the Freedom Caucus to get McCarthy ejected. They need 218 votes to do that. They probably get a majority, maybe like 45 House Freedom Caucus members, which is their whole caucus. But that leaves 177 other House Republicans who, by the way, just voted to install this man. And there are no other Republican candidates waiting in the wings to take his place for a thankless job. So all that needs to happen, and I think this is what, some of the publications out of D.C. are missing, is Hakeem Jeffries, the new minority leader for the Democratic caucus, who's done a tremendous job keeping his caucus in line so far this year, can allow his members to just vote present. And it is a way for Democrats not to signal their support for Speaker McCarthy, but to force the Freedom Caucus to show that they do not have a majority and are not capable of governing the House either. So I think this motion to vacate piece is underappreciated, how small the force the Freedom Caucus actually has. Frankly, I'd love to see the vote and have McCarthy come out and sort of shut them down. The faster that happens, the better.
Henrietta, I just wanted to finish on this. The quote from the UAW president yesterday. We were looking forward to getting your reaction to that. I'll share the quote again, that every fibre of our union is being poured into fighting the billionaire class and an economy that enriches people like Donald Trump at the expense of workers. What is this going to look like month end in Detroit when on September 27th, the former president is talking about visiting, and at the same time we have a second debate for GOP candidates?
I think it's going to be fascinating to see Trump maybe not show up for those debates yet again, and see if there's fractions between the Republican presidential candidates to see who wants to support the labor unions, who wants to support the auto industry, and who doesn't. That was a huge deal. We talked about this last time. I made an ill-timed joke, but Mitt Romney ran on the campaign platform of the auto bailout was not a good idea. The last time auto workers really embraced a Democratic president and their sort of true star was Obama and the auto bailout. So I think the Republican Party has a very tricky narrative to define here, and Biden continues to be at the table. I don't know that they're moving the needle yet. And to your point, I think that the strike very well could be still going on. But Trump is going to have to walk a fine line that alienates a lot of the Republican platform here, especially with government staying out of business.
Yep. Henrietta, thank you.
Fantastic.
Henrietta Trey's there of Vader Partners. Coming up next on this programme, Jonathan Pingle of UBS and a new call from Nomura on why they think this Bank of England is on hold tomorrow. Details of that call up next. Need a countdown clock if we don't have one already. I think we're 5 hours and about 30 minutes away from a Federal Reserve non-decision, unchanged as the call. Plenty of action expected in the forecast for this year and next. We'll talk about that in just a moment with Mike McKee in Washington, D.C. Equity futures on the S&P just about positive by 1/3 of 1%. We're higher here on the S&P and the Nasdaq up by 1/4 of 1%. The Russell higher by 1/2 of 1%. Talked a lot about the calls coming out of Bank of America. Savita Subramaniam now looking for 4,600 year end, just a couple of percentage points higher from where we are. That call up from 4,300 previously. A couple of revisions there, a couple of revisions from elsewhere as well. BNP Paribas. Big bear, Greg Bowdle, throwing in the towel on that bearish call a little bit earlier in the last couple of months. Outside of equities in the bond market, 2-year, 10-year, 30-year, a rally on the 2-year in the UK, a bit of a rally on the 2-year in the US. We're down 2 basis points, 5.07% on a 2-year. We're looking at cycle highs at the front end of the curve, cycle highs on a 10-year at 435. All of that going into the Federal Reserve, Tom, tomorrow.
There's some real jumble here, and Alberto Gallo was shocking there, particularly on EU distress. John, verbatim, David Rosenberg up in Toronto. We take the view that we just experienced phase 2 of an extended bear market rather than the beginning of a bull run Phase 3 still lies ahead of this. That's from the great disinflationist David Rosenberg.
Let's get to the UK.
Some of the caution there.
The pound, 123.70. Tom Goldman says
part
we're
of
done.
that.
The Bank of England is done. Nomura out with their call. This is Mr. George Buckley. He says the Bank of England is on hold tomorrow after the big surprise in CPI today. So we thought downside surprise on inflation would mean potentially a coin flip. Nomura says no hike. Goldman says no hike. The pound's a little weaker, 123.70 on sterling. Jordan Rochester over at Nomura, George's colleague, looking for 122 and staying short sterling.
And is it a stagflation-y lesser growth, as David Rosenberg alludes to there indirectly with his equity market at call? But, you know, here's this trend off of data. I guess it's data dependency. But it really harkens to then how does it fold over to the growth call? And
This is what Arcelinios said, and Lisa mentioned this earlier this morning. I think it's a really good point. If you get a better growth profile because these central banks back off, is that sterling positive or sterling negative?
That's the ambiguity of it.
And she said it was ambiguous.
That's the mix. I'll go with the ambiguity of it. Let's do this. Let's dive into this Fed meeting. We'll again have our full coverage from London this morning and from Washington. Michael McKee is Bloomberg International ambiguity correspondent and joins us right now. Mike McKee, for Jerome Powell today, what is his chief ambiguity?
The fact that the Fed doesn't know what's going to happen going forward, which sounds silly because nobody can predict the future, or as Yogi Berra said, predicting is really hard, especially about the future. But there are a number of things on the horizon that could really mess up what the Fed's forecast for interest rates would be going forward. You've got the UAW strike, for one thing. You've got the war in Ukraine, oil prices, the student loan payments coming back, Russia's war in China's economy. So there are a lot of things they don't know what's going to happen. So the best case for them is probably to sit tight. I don't think they're going to move rates. Nobody really does. But then the question is, do they change the dot plot? Do they suggest that they don't need to cut more?
Right.
And I don't think they'll do that either.
Mike McKee, Fed tradition is you get the last question because of your power, grace, and heritage. If you had the first question today to Jerome Powell, what would it be?
Well, I think a logical first question, although I don't know it would be asked, is how much confidence do you have in anything that you're telling us today? Because there are so many possibilities for things to go pear-shaped that you have to wonder if people could put much stock in what the Fed is forecasting. I think John was making a good point before we came on here when he was talking about the pound. Currencies are probably going to be where you see the reaction this week. On Friday, the dollar's been rising. And is it going to still be rising after the Bank of England makes their decision and after the Bank of Japan makes their decision, and both of them following the Fed? We may be kind of at a bit of a turning point here, and the Fed may become a little bit less relevant.
John, I think we just saw there why McKee gets the last question
I'm going to suggest
and not
that
the first question.
might be why Mike McKee doesn't go first in that news conference, particularly if Mike's planning to ask that a little bit later in the presser. Mike, Citi published early this morning. I'm sure you saw the work of Andrew Hollenhorst. He offered up 3 points, 3 stories, 3 dimensions to the inflation debate. He said oil prices, UAW strikes, and house prices. From your perspective, Mike, how do you anticipate Chairman Powell will navigate those 3 issues?
Well, oil, for the moment, he's got to say we looked through that because we don't know where oil is going and for how long. And we can't lower oil prices by raising interest rates. If it went on for a long time and inflation expectations got unanchored, then the Fed might want to do something. But they're going to put it in terms of the inflation expectations. As far as house prices, they know they've been rising in recent months, but the house prices take a long time, as we've said, to get into the economy and into the data. And right now, it looks like what we're seeing is still declines from the declines that we had over the past year or so. And finally, when you look at the UAW strike, again, that's going to depend on how long it lasts. I would have added the government shutdown, because if the government shuts down, there could be a lot more people along with the UAW if it broadens the strike who are on unemployment benefits. And that could mess up the numbers both for unemployment and employment and make it even harder for the Fed to know what's going on.
Payroll's a few weeks away. Mike, thank you, sir. Mike McKee is going to be with us a little bit later, breaking down this decision and all the forecasts as well at 2 p.m. Eastern Time. Our special coverage begins at about 1:30 Eastern Time. A 30-minute drumbeat into the decision, some 30 minutes of analysis going into that news conference, a special one-hour programme hosted here in London. Just a programming note, tomorrow we are here for our Global Credit Conference here in London. Tomorrow we'll be catching up with Apollo's Jim Zauter. Jim Zauter joining Bloomberg Surveillance, especially for that conference, Tom. So
and after the Alberto Gallo conversation, that's going to be an incredibly interesting conversation. And the ascent of private equity, private companies, and that the Zauter conversation is going to be important.
Stagflation.
Yeah.
The word that Alberto used for both the UK and Europe. And then he said the prospect of re-accelerating inflation in the United States and the difficulties invested around that.
All the different narratives we've got right now. Let's begin our Fed coverage for this afternoon and into the London evening with Jonathan Pingle, Chief U.S. Economist at UBS. Jonathan, on this Fed, I'm making jokes. It's a snooze fest as we lean to November and December. And as you say in your research note, we are completely data dependent. What data is Mr. Powell dependent on?
Well, yeah, thanks for having me, Tom. I mean, I think first and foremost, obviously, I think it's really the inflation data. And I think this is actually one way in which, you're talking about ambiguity, that Chair Powell today is not going to have the old Chairman Greenspan-like ambiguity. He was pretty clear at his Jackson Hole speech when he laid out the conditions for raising rates further, said they were prepared to do so if appropriate, and all three of those things were related to inflation. One was inflation fails to improve as much as they expect, growth is too strong and puts the improvement in inflation at risk, or the labor market remains too tight and puts the inflation improvement at risk. So I think if you had to think of the summary statistic for Chair Powell and the data, I really do think it's the inflation data.
You survived working with fixed income at BlackRock. For an economist, that's always sport to say the least. Link your world and Jerome Powell's world into what we're going to see in interest rates off this meeting.
Well, I think, going into this meeting, based on, sort of the conversations we've had and our strategists, that, it does seem like a lot of the commentary has people setting up for a hawkish skip or, some sort of incrementally hawkish message here. I'm not actually sure that's really going to be the case. All of the information they've gotten has been pretty positive, actually, since the June meeting, since the July meeting, what they got in the quiet period. I mean, inflation's falling much faster than they had written down in June. Non-farm payroll employment has slowed, quite substantially, but still healthy. But it's really gone a long way and towards slowing the way they want it to. And right now, after the CPI and PPI and the other inflation data, we're tracking August core PCE inflation at 3.8%. That's already below their full year 23 projections from the June summary of economic projections. So for the FOMC participants, it does look like they've gotten a lot of good news on inflation without the economy really rolling over. So it looks to me like they're in a pretty good spot with inflation falling faster than they expected.
Mm. Well, Jonathan, three-part story today, as you know. Statement, projections, news conference. Would you expect then, and I think this is what people are anticipating, maybe a little bit of a Goldilocks soft landing assessment in the statement, perhaps the forecast, but ultimately in the news conference, that vigilant, more hawkish stance you might get from Chairman Powell? Would that be the three-part act you're looking for?
Yeah, I mean, I think the statement is going to have some changes, but I think the real action is in, as you say, Jonathan, it's going to be in the SEP and the dot plot in particular, and then how Chair Powell frames it in the press conference. I don't think the SEP is going to be quite as hawkish as a lot of the the projections that are circulating around. But I do think in the press conference, Chair Powell is going to say that they are remaining vigilant. And just like he said in Jackson Hole, I think he says the committee's prepared to raise rates further if appropriate. But I don't think he's going to commit to raising rates further. I think at this point they are very data dependent. They're willing to watch the data come in. Inflation's been better than expected. I think they're in a pretty good spot right now. I think they're generally pretty happy with what's unfolding.
When someone stands up in the news conference and says, Chair Powell, look at gasoline prices, look at commodities, look at energy, What do you think the pre-prepared answer he has in front of him is?
Well, I don't want to undo Mike McKee's genius here, but I mean, I do think they're at a point right now where they're going to look through it and wait to see if it's a more sustained move higher. We've had a couple of periods where, Brent has pushed up sort of $88 a barrel since November. Now it's sort of pushed above 95. We'll see if it stays there. One of the problems they have with the energy prices at this time, they do know that if it just stays there for a year, inflation's a growth rate, so the inflation will go to zero. So far, it looks to us like there's only going to be modest pass-through into core, like pretty minimal, and I think that's going to be their assessment for the moment as well. So I do think that, they're going to look through it and wait to see if it does threaten the progress on core inflation. And as Mike McKee noted, the big thing for them is going to be watching inflation expectations, which thus far, the most recent incoming survey and other data has looked pretty good.
We'll see if Mike McKee's allowed in the news conference a little bit later. Jonathan, thank you. Jonathan Pingle of UBS. Appreciate it, John. Good stuff as always. Thank you very much, sir. Mike McKee will be in that news conference a little bit later. If you are just tuning in, welcome. The S&P 500 positive here by 0.2%. Yields going, let's say, absolutely nowhere. 434.87. But in the last 24 hours, cycle highs basically at the front end and on the 10-year. On the 2-year through 5% still. On the 10-year in the 430s, on the 30-year in the 440s. Yields are elevated here, Tom. Going into this one with Chairman Powell and the Federal Reserve.
It's a moonshot. They're not elevated. They've been going straight up, like oil has gone straight up. And I think this goes back. The thing I would do, John, draw the horizontal line from where we are now on any of those yields, and you go back. And the answer is it's not August of 07. Maybe it's 08, 09. Maybe a few selected ones are back into 07. But Chairman Powell goes into this meeting with a rate regime from our youth. That was a long time ago.
Is that where he wants it to be?
The question, I'm optimistic about that. We've had a lot of optimists on the shows. Ben Laidler starting us off today.
Max Kettner, another.
And the answer is we adapt and adjust, and corporations adapt and adjust to that rate. It drives people nuts. Paul Krugman says we're in a disinflationary trend, and we will be with good comparisons going out. People get upset because they're looking in aisle 7 at their grocery store going,
Things
I don't,
expensive.
I'm sorry,
but
this
you
is
and
what
I
it
are on the
costs.
same page about this.
Yeah.
You can't just strip out the things you don't like, energy and food prices, and say, well, look at this, it's not as bad as you think it is.
Yeah. Some breaking news here. This is Zeppelin Foundation, I believe it's called ZF in Tuscaloosa, Alabama. It's a UAW organization and strike. This is Mercedes high-end chassis. But that's that geography of this UAW strike. Is that what we're going to see on Friday?
How much more of this will we see announced by the UAW president at the end of this week on Friday in that Facebook Live event? From London, Mark Cudmore up next.
It looks like you're going to have a divided committee. We're on the side of them still having the median voter with a dot, but it's a close call. I think regardless of that, and regardless of big changes in the forecast for 23, the 24 forecast is still going to have something close to 100 basis points of easing. It's still going to have a big drop in inflation. It's still going to have an aspiration that we get an unemployment rate up to 4.5% without a recession.
That line there was brilliant from Bruce Kasman at JP Morgan, the head of global economic research. An aspiration. He didn't call it a forecast, he called it aspirational. More on that a little bit later on when we get that Fed call and those Fed aspirations, if you want to call them that, in the summary of economic projections. Equities right now going into the opening bell about 43 minutes away. Futures elevated, positive by 1/3 of 1% on the S&P. Plenty of price action in the commodity market over the last week or so. New highs for the year, 95 on Brent. We back away. WTI still just about in the 90s, backing away by about $1 full. We're down about 1.1% on the session. The headline, though, in the bond market, and I have to say, Tom, it's hardly made any headlines. The fact we're in cycle highs in the last 24 hours.
I agree.
On a 10-year maturity, on a 2-year. Yes, we've backed away from those levels, but shouldn't we be talking about this a little bit more?
I think we should. I mean, the bond market's there, and a 509 in the 2-year yield is there, and I'm going to watch the real yield coming off the Fed meeting. And frankly, as you mentioned, with Nomura and Goldman Sachs going on Bank of England, the Bank of England to a no rate change or a hold. I'll let them nuance that. It's hugely fungible right now, and it makes it for a very interesting Fed meeting this afternoon.
The Goldman say no hike tomorrow. Nomura coming out in the last 10 minutes or so saying no hike tomorrow.
We had a listener and a viewer email in. This is Guy from England. And
Guy
says,
Johnson.
Yeah, he said, there's enough football talk, and we did AC Milan and the rest of it, but we've got to really focus here. He wants equal opportunity at the Decathlon Saint-Denis Stade in Paris this coming weekend. Why don't we talk rugby, John? I mean, you taught me about English football
I was a terrible
and
rugby
Formula
player.
One.
That's why I don't talk rugby.
It's huge here.
Shocking.
It's like, it's like on TV,
here,
and it's like there's like a world champion here.
It's a big deal.
We go to surveillance rugby correspondent Mark Cudmore, who joins us right now. Before we get to bonds and all that, you're in Singapore, and you're looking at rugby worldwide, and you've got Ireland, South Africa this weekend. Explain the majesty of that to you as an Irish lad.
This is just absolutely immense. Ireland is very rarely the #1 ranked team in any team sport. We just don't have a big enough population. We are #1 ranked in the world. We're on, I think it's a 15-game unbeaten streak. We've beaten all the other major nations when we've last played them. What's the catch? Well, even though we were Grand Slam champions earlier this year as well, the catch is we've got knocked out of every World Cup at the quarterfinals. We've never got beyond that stage.
Because New Zealand's in the way, right?
I'm not that worried about New Zealand. The All Blacks aren't as intimidating as they once were. Right now, it's South Africa and France I'm worried about. The South Africa pack is just so strong, and France have home advantage. So really, I think that Ireland have a great chance, but it's between those three teams. I'm not counting the All Blacks as serious contenders.
Let's continue. Anything intimidating about these central bank decisions in the next 48 hours?
I'm a little bit disappointed we're switched away from the rugby, but I do need to correct you. 2-year yields are not at cycle highs.
On
I have
a closing
vested
basis,
interest in this.
cycle high,
At the closing
5.09%.
basis. But I have a
Sure.
vested interest because I've actually swiveled my view, because the last couple of years I've been very adamant that yields go much higher, and I kind of really pushed back in the early premature Fed pivot idea because everyone was underestimating the consumer. But now the US consumer is finally going off a cliff. So all those people who were trying to call a recession way too early are now suddenly abandoning their recession calls, talking about soft landing at the exact point when the consumers go off the cliff. So I've just recently changed my view on 2-year yields, which is why I have a vested interest in saying it hasn't yet broken that peak of 5.12%
Oh, Mark, you're kidding
on an
me.
intraday basis.
On a closing basis,
I accept.
cycle high. OK, 10-year, cycle high. OK.
Closing basis, I'll accept.
Sure. I think intraday, cycle high on a 10-year.
Yeah,
Thank
it is,
you. OK, we can move on. TV doesn't have to be this hard, does it? Does it?
Well, it's Cudmore. What do you want?
All right, Mark. Let's move on. What are you looking for?
So, out of the central bank meetings, well, because I think that the yields have peaked. I think the price action around that has been very, very kind of impressive at the front end. I do think we'll continue to see the curve to steepen. So I think what we're going to go into is the Fed will probably hike once more this year. I think that's out. And I think the 2-year yields can survive, peak, can survive even another hike in November. They just can't survive if we get a hike and then a promise of more hikes to come. But I don't think that's going to happen because I think in line with Bloomberg Economics, I think Anna Wong is the best US economist out there. And she has highlighted all along that there isn't going to be a recession all the year, rest of the year, when everyone else is calling it, but the consumer is going to go off a cliff. Starting at the end of the fourth quarter, we'll get a US recession. Yields will come lower. Now, I don't think the Fed actually tonight is going to be the instant catalyst tonight, but what I think is going to be interesting is everyone is geared up, not everyone, most people are geared up for a hawkish Fed, which is why we're at the cycle peak in yields on a closing basis right across the curve, John, is because they're geared up for a hawkish Fed. Therefore, I think the bar to surprise hawkishly is very high. So ultimately, I think the price action after this is yields come lower and the dollar turns lower into year-end as well.
How does the Cudmore world focus into equity markets? How do you filter bond dynamics down to the equity call?
Yeah. That's a really good question. So I think if you think...
I flunked at rugby, but we're killing it on the equity.
I preferred the rugby one, actually. But, I think if we're going to get... So normally 2-year yields peak a couple of months before the start of a recession. And US equities are actually less of a good leading indicator. We had the recession post-World War II where US equities rallied all the way through it. They're not always a consistent leading indicator. But they normally, with a low statistical significance, they have a median lead time of 2 to 3 months of when the recession starts.
Right.
So if you think a recession is going to start in fourth quarter, you should be looking for a peak in the US equity market around September, October. And that's what I've kind of been talking about. I made the mistake last year of thinking US equities would underperform. I luckily capitulated on that very, very wrong call in March. Since then, I've been bullish. I haven't yet turned bearish US equities, but I'm looking for that turn. And I wonder whether I've already missed it. Maybe tech is already showing that the turn is already there, but I think we maybe get one more high.
What are the ramifications if the Bloomberg total return, I look at the US aggregate total return index, if price comes down and breaks through to a new lower price of aggregate debt with a higher yield? Is anybody prepared for that?
I mean, no more prepared than they have been for the last few years. You've probably seen it for all your guests. I've seen it for all my guests on the morning shows that everyone wanted to be long duration all year. People keep on getting on the wrong side of this. And as I said, even though I think 2-year yields are going to come lower because I think the economy is going to turn south, I think we're going to continue pricing back in the term premium. We're going to continue pricing in normalising bond markets that have been distorted and broken for the last 15 years. And that because the fiscal supply next year is going to continue going up, and we're not going to curtail fiscal deficit, especially going into an election year with the economy slowing. So I think you're going to see a lot of yield curve steepening over the next 6 months. Quite aggressive yield curve steepening. I think that's a big understanding.
John, I think we're completely unprepared if we get this low probability outcome of price down through the low price, high yields of 12, 18 months ago.
Great call from Priya Misra at the start of the year.
Oh, yeah.
That's just fantastic. Inversion all year,
Absolutely.
which is basically where we've ended up. Got a few more months still to go. Mark, thank you. Good to see you. Your equity market on the S&P, positive by 0.3%. Going into 3 big central bank decisions. The Federal Reserve a little bit later on this afternoon. On to the Bank of England tomorrow. Latest call from Goldman and Nomura. No change. They're on hold. The Bank of Japan on Friday. Tune in 1:30 Eastern Time for a Bloomberg Surveillance special, The Fed Decide. We'll be joined by Kathy Jones of Charles Schwab, Matt Lizzetti of Deutsche Bank, Diane Swank of KPMG, Andrew Hoddenhorst of Citi, Tom, looking for that interest rate hike again from the Federal Reserve in November, together with a team over at Bank of America.
And we start right in tomorrow. It's going to be fun to be here for the Bank of England decision. Do you and I get to stand out front of the Bank of England
Would you like to do
Lizzie
that?
does?
We can do that with Lizzie.
You know,
We'll
stand out front. I can wear a Burberry trench coat. And,
You've never done that before?
I've never done that.
There's a lot of traffic that used to go by, but now they're trying to pedestrianise that area a little bit, aren't they?
Okay.
You noticed that?
Very
All the bikes going past. We can
These
do
are not small matters, and I don't agree with some of the zeitgeist. Japan's off the map with yen at 147, 148. I think that's a germane story for Western investors.
Dollar
as well.
strength. It's been a big issue. Mike McKee was talking about that, TK.
Yeah.
Is that about the rest of the world, or is that about the United States?
Both. It is about to begin the morning, as we did here in London with Ben Laidler. It is about that long duration innovation play, and of course we heard that from Kathy Wood as well.
I love what Bruce Kasman said over at JP Morgan today, referring to their forecast as aspirations. Do you remember Diane Swank talked about that over at KPMG?
She'll be with us this
Same
afternoon.
thing. Same thing.
It'll be the same thing. What I would really focus on, and this goes into all the different narratives and opinions that we have, is this is still original territory. We forget we're coming out of a pandemic. I happen to believe we're seeing still pandemic dynamics. We're not free and clear of COVID, forgetting about the new booster debate and all that. But it is original economics that's going on now. And because of that, each and every of these 3 banks are going to say the same thing. We're data dependent.
Line of the morning, Mike McKee. How much confidence do you have in anything that you're telling us today?
Yeah.
His question in the news conference
First
with Chairman
question.
Powell. How do you think that's going to go in that news conference with Chairman Powell?
He goes in with 16 questions, and they all start in. They don't want to go to McKee. Everybody in the press conference has like an official name, and at the end it's Mike.
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 What have you got?
What do you
We've saved
got?
Till
And
last.
so
What do you
he
have?
goes through his list of questions. There's 3 of them, and he asks them, have you been to a Dead concert recently or something?
He has been to a Dead concert, right? In Washington, Mike McKee breaking down that decision for you at 2 p.m. Eastern Time. Special coverage starting at about 1:30. From London, for our audience on TV and radio, thank you for choosing Bloomberg. For our audience worldwide, this was Bloomberg Surveillance. Equities are up. Good morning.